Hi there, you're listening to Best of the Week Weekend Review. I'm Grant Walker, and as the title of the show suggests, you are listening to a selection of the most read online business news articles from the past week, chosen from our twice daily free email alerts Heads Up and Last Call. Here's what's ahead. Matthew Hooton talks about the fortunes of the Conservative Party. Rodney Hyde discusses a referendum on tax. Lance Wiggs and MBR staff, Nick Grant, Nathan Smith and Chris Hutching discuss the week's big talking points in our weekend rumble. Jason Walls breaks down the situation in Greece. Tim Hunter talks about the low watermark in fund management. In Media Watch, Nick Grant and Campbell Gibson discuss MediaWorks ratings. Rob Hosking breaks down the New Zealand First Party's secret deputy leader election. David Linklater talks about the car of the week. Hamish McNichol talks about anti-money laundering and more, right here on NBR Radio. In market news, Xero has inked a partnership with cloud storage leader Dropbox, continuing a trend of recent tie-ups with A-list outfits. Chief Executive Rod Drury told NBR Radio, "We set out to build our brand in new markets by partnering with well-known brands, especially where by working together we can make better products for our customers." Over the past few months, we've announced technical partnerships with Bill.com, Avalara, Mindbody and Apple. Xero also recently signed a partnership with Google that will let its customers create invoices and quotes from within Gmail. A lot of such industry partnership announcements are drivel, at least from the shareholder perspective, because the lead company concerned is hooking up with all comers. But as with its recent Apple Store alliance, Xero has category exclusivity with its Dropbox deal. No other accounting software company is on board, at least for the foreseeable future. Dropbox's Australia-New Zealand manager Charlie Wood won't totally rule out working with Xero rivals like MYOB, but there is nothing on the table. He says the cloud-only Xero was the most natural fit. The partnership will allow Dropbox users to share documents directly from their personal or business accounts with a Xero account. Dropbox will also be a major sponsor of Xero's XeroCon conference in Melbourne in August. Dropbox claims 400 million registered users worldwide. Mr. Wood says in Australasia it has more than 8 million. In receivership news, Westpac is the biggest creditor in the collapse of a subcontractor to the Central Plains Water Scheme in Canterbury. Aqueduct New Zealand was placed in receivership recently, and the first receiver's report says Westpac is owed $4.97 million. Unsecured creditors are owed $2.3 million. The total outstanding amount owed to all creditors is $8.1. Receiver Colin Gower of BDO is continuing to trade the company and retain staff. The assets of the company consist of a mobile pipe manufacturing factory and ancillary machinery at Hororata with a book value of $6.1 million and scrap pipe stock with an undetermined value. The receivers said at the date of our appointment, accounts receivable of $1.56 million were outstanding, of which a certain amount is subject to dispute. Another 3 related companies have also been placed in receivership: Can Power, Galley Holdings and Bosch Irrigation. Central Plains Water Chief Executive Derek Crombie says the irrigator is unaffected by the collapse of its pipe supplier and is pushing ahead with further stages of the scheme with the benefit of government grants and funding support.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio on Friday the 3rd of July. I'm Andrew Patterson, with me Hamish McNichol for our weekly court report. Hamish, let's start off with the Auckland gold trader and company director Robert Kairua, 53, sentenced in the Auckland District Court for pleading guilty and being convicted of numerous SFO charges.
Yeah, Kairua was the director of this company called Grace Holdings New Zealand Limited, which traded under the name Bullion Buyer. And in 2012, it went into liquidation, and at about the same time, the SFO launched an investigation into it. This case had gone quiet for a little while until NBR's Duncan Bridgman made a few inquiries last week, and then the SFO banged out a press release. But basically, he's being sentenced today. It was found that the company held investor funds of approximately $2.7 million, and he misappropriated about $370,000 of that. Basically, he pleaded guilty to 13 charges of theft and 9 of making false statements. He in his investment statements, or brochures, he'd said that he was more qualified than he actually was, what exactly the trading his company was doing was, and insurance and storage of the gold. So it's an interesting little case, and it's, like I say, it's gone quiet for a little while, but SFO's investigation began in 2012, so it's all coming to a fruition today.
Indeed. As we spoke about earlier in the week, a substantial foreign exchange dealer and currency remitter fighting back against Kiwibank's attempts to close its banking accounts and facilities. That's a decision that would probably end its business. This is all part of the Money Laundering Act.
Yeah, we spoke about this one fairly extensively on Wednesday. It's involving that company eTrans International Finance. Basically, Kiwibank has tried to shut down its account because it says it's too big a risk given those anti-money laundering regulations. We've had a little bit of feedback on this story. Lance Wiggs in particular, who comes on to NBR Radio from time to time, commented that the extension of the draconian AML regulations to money transferring has a chilling effect on business, and especially on inbound tourism and foreign students here. Some care is required. And I actually got a few emails yesterday as well from people with similar sorts of lines, basically saying it seems as though, while it seems that Kiwibank is flexing its muscles a bit here, it also seems like they're sort of stuck between a rock and a hard place, I suppose, and maybe it's the regulations that are at fault here rather than anything the bank is doing. So we're still some way from this being heard, and I've gone to the Bankers Association to see if they've got anything to say about it. These regulations have been controversial in the past, and as we noted on Wednesday, the Reserve Bank did tell banks in January that they need to chill out on closing all these accounts. Apparently 8 of the 15 foreign exchange dealers and remitters around Auckland have had their accounts closed. So yeah, like you say, the impacts on tourism and foreign students could be quite big. So a lot more to come on this one, I think.
Yes, indeed. And, of course, banks would be reluctant to close any account, assuming this is a business that, pays its fees and it gets it. So, but clearly the bank is obviously wanting to protect itself against the rules. And, of course, the penalties for breaches of this particular act are very significant. Let's talk, too, on Thursday, the Wellington accountant that's been suspended as a chartered accountant after going bankrupt, but continues to work in the industry despite an inability to manage his own finances. How bizarre is this?
Yeah, another one of these sort of local industry or industry body disciplinary tribunal decisions following the lawyer that was struck off on Tuesday. Basically, this guy Brian Hutton of Upper Hutt was last month suspended as a chartered accountant for the duration of his bankruptcy, so for 3 years. He was declared bankrupt in February. Though the tribunal did say that this was for reasons unrelated to accounting, and he wasn't actually working in accounting when he was adjudicated bankrupt. But he has since taken a job with a chartered accountancy firm. So while his chartered accountancy status itself has been suspended, he can still continue to work there, but he had sought name suppression and things like that. But basically, as the tribunal said, the fact that he's gone bankrupt himself maybe doesn't speak too well to his ability to manage the books of himself and perhaps others. So, it was just a funny little one, I thought.
Yes, and not exactly expecting a queue of potential clients to be lining up outside of his office with a track record like that.
No, exactly.
Right. Thanks for joining us for our weekly court report. Hamish McNichol on NBR Radio.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
You're listening to Best of the Week Weekend Review. Hi, I'm Grant Walker. I'll have Heads Up for you 10 a.m. Monday, and we'll update you with Last Call from 4 p.m. And this happens every weekday here on NBR Radio, free to air online. NBR, the meeting place of intelligent business. In market news, the ACCC, that's the Aussie equivalent of our Commerce Commission, put a bomb under the taxi charge industry across the ditch yesterday. A landmark ruling says cab charge, which dominates the Australian market, must allow rivals cards to be used on its taxi terminals. Challenges, which since December have included NZX-listed SmartPay, have been unable to negotiate access. Managing Director Bradley Gertis told NBR last night it's good news for the Australian taxi market and consumers in general. It'll promote competition and it comes at a good time for SmartPay. The Managing Director says most of SmartPay's revenue comes from its taxi and bank business in New Zealand. Its plan to grow revenue and profit is centred on expansion across the ditch. There is still work to do. Mr. Geddes says SmartPay will have to adapt to cab charges terminals, but the development work is within our capabilities. We haven't seen their spec, but we write to different specifications all the time. It's our bread and butter. Until December, SmartPay partnered with cab charge rival Live Taxi ePay, supplying half of Live Taxi's 15,000 payment terminals. After a bad-tempered breakup, the pair is now tussling in the New South Wales Supreme Court, with Live Taxi ePay claiming it's owed compensation for terminal breakdowns. Mr Gertis refused to comment on the case beyond pointing NBR to a market filing noting SmartPay's counterclaim that it's owed 600,000 Australian by Live Taxi and is confident of a win. Let's talk debt. A business leader says a good chunk of company debt is masquerading as mortgages in New Zealand. Business New Zealand Chief Executive Phil O'Reilly says in New Zealand there is hidden debt which is not being reflected in the borrowing statistics when a small business owner has leveraged their house to finance their venture. He says this is common practice for new entrepreneurs as the bank will treat the loan as a mortgage. Banks in New Zealand tend to be less focused on small businesses and more focused on lending on property, he says. Mr Riley says you tend to find a business person owns their house and has plenty of equity in it. They use that equity to grow through bank debt finance and that will turn out to be a mortgage payment. Callaghan Innovation Chief Executive Mary Quinn agrees, adding this is a common scenario for SMEs in the early stages of funding their businesses. She says by putting their own resources into an asset on behalf of the business demonstrates belief in the product and the market they're going after. But because of this, Mr O'Reilly suggests small business growth can be sluggish as the owners often take fewer business risks. He says if you put your house at risk and it's just you and your family involved, then the chances of you taking a bigger risk on your business is minimal, as you could lose your house. He said, we're losing out around the opportunities for small businesses because of this. It's one of the reasons small businesses tend to grow a bit slower. Although there are some ways to finance smaller businesses, such as through angel investors, MYOB's SME Solutions General Manager James Scollay says these are few and far between. He says fewer than 3% of SMEs have historically sought funding from angel investors. This morning, NBR Online revealed borrowing for housing has been steadily climbing, while borrowing for businesses has been relatively flat for the past few quarters. The figures from the RBNZ revealed total household borrowing is up 6.3% for the most recent year.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland and welcome to our weekly hit with Matthew Hooton. And Matthew, you've been dissecting the meltdown in the Conservative Party.
Yeah, well, it certainly looks like the Conservative Party, as we've known it, is all over. There was a whole lot of speculation before the last election that it might have been a party that John Key would have thrown a seat to. The talk was East Coast Bay's, Murray McCully's seat. That didn't happen. John Key judged, I think, that the harm of being seen as too close to the Conservatives and the sort of moral majority types to his brand was too great. It didn't get 5% on the end, so it's not in Parliament, but it is significant because when you look at the New Zealand voting base, there has to be 1 in 20 voters who support the types of policies that the Conservative Party talks about. They're sort of people that are uncomfortable with economic liberalism, so they're not entirely comfortable with what's happened in New Zealand since 1984, although they're largely ambivalent about that, but they're desperately opposed to social liberalism. And, all the Conservative Party needs to do is get 125,000 of those votes, and it's in Parliament, and those people get represented. And you would think it was possible. There have been various attempts to do it. This one has now really come to an end, regardless of what happens. I don't think anyone would now think that a Colin Craig-led Conservative Party will ever get 5%, and it certainly isn't a party that John Key will want to deal with.
Of course, Colin Craig hasn't gone away just yet, and some would say that the Conservative Party is Colin Craig.
Well, that's right, and it's sort of similar to Kim Dotcom's Internet Party in that respect, isn't it? That the main funder of the party, the founder, the person most associated with it is Colin Craig. But you see, that's not how many of the people that supported him saw things, and that's what's at the heart of this dispute. It's not really so much about, should we use the euphemism, inappropriate behaviour.
Don't you love that? And parading in front of the cameras with your wife.
It's about what it is that Colin Craig really saw this party as his. He was the funder. He was the one with the media profile. And he thought that whatever happened, he would always be in charge of it. But it actually has a formal constitution. It has a reasonably large membership. It was successful. And the people who joined it, like John Stringer, who is sort of seen as the nemesis of Colin Craig on this issue, and people like Christine Rankin and people from the Sensible Sentencing Trust and Family First, they joined this party thinking it was a regular, normal political party.
And it was getting some cred.
And they were part of it in the conference as well. I spoke at one of them, as an after-dinner sort of speaker before the election. And it was well attended, and it was a proper party with branches and all those sorts of things that you associate. So what's happened here is Colin Craig, since 2 days before the election, of course, the press secretary resigned because of the matters associated with the inappropriate behaviour. He's gone to ground. He hasn't really been fulfilling the role in the media as leader. They didn't stand in the Northern by-election. So anyway, through that time, people like John Stringer have been trying to get rid of him. And they seem to have the numbers, or did seem to have the numbers to do that. And they even suspended his membership from the party. And the question now is, which may end up in the courts, is who suspended who first, because Colin Craig is saying that he held a board meeting on 2 Thursdays ago, late at night. No one quite knows. There were no board papers, there was no agenda, members of the board weren't all invited, but anyway, Colin Craig says this was a board meeting where Mr. Stringer was suspended from the party. And if that's wrong, then I don't think there's any doubt that Mr. Stringer's board is the legitimate board of this party. But, this is all going to get sorted out through the courts in the long run. I think the Electoral Commission needs to get in here fast. There is money in a bank account. There is a brand. There is a registered political party. There are 2 factions saying they're in charge of it. There is a need for the authorities to sort this out. But in the end, it doesn't really matter how that goes, because I think Colin Craig's fatally wounded. And I'm not sure that Mr. Stringer and his friends are necessarily the right people. I think there are other people, wiser heads in the sort of conservative moral world, in the Sensible Sentencing Trust, Family First. I think they need to step in and say, look, there should be a party like this, and we're going to do it properly.
You're listening to NBR's Weekly Hit with Matthew Hooton. As you point out, Craig may be dead in the water, the party may be dead in the water, but there is a constituency, and a reasonably sizable one here.
And a passionate one. These people deeply believe that it's just appalling. They think gay marriage is just absolutely appalling. They think that state schools should be teaching morals. They think that the government should worry more about regulating finance companies than the family home. They think that they should be able to, strike their children as part of discipline. They like prisons. They think people should go to prisons for a long time. They don't agree with Bill English that prisons are moral and fiscal failures. They don't like it when John Key kisses Buffy and Bimbo at the big gay out. It's so this is the sort of and it's perfectly legitimate. And I'm sure that there are 5% of them now. And they will vote on those issues. And I think what needs to happen is some type of constitutional structure for a party like that that's not around one person. And I think they should look, ironically, to the Greens, who also have a sort of religious zeal to their sort of beliefs. They have a whole lot of people who are from sort of moderate environmentalists who would like to clean up the rivers a bit, through to people that think that homeopathy can cure Ebola, and so they've got their nutcase wing, through to the. So, but the Greens have been very successful managing that very wide and diverse group of passionate supporters, from the relatively sane to the absolute lunatics, but they managed that. And so whatever the Greens have done in terms of their constitutional structures, consensus decision making, and all that sort of thing, maybe that's something that the Conservatives should look at, because they have a similar big problem, that some of their supporters are going to be really way out there people, and parties like the Greens, potentially, or the Conservatives, or in the old days communist parties, used to have, or far-right parties, used to have problems with schisms and all this sort of thing. So, but the Greens have succeeded all these years, maintained unity, changed leaders successfully a few times. So whatever the Greens have done, the Conservatives should look at as a model for them.
And in terms of the National Party, they got out of jail by not offering the Conservatives a lifeline, a wise decision in hindsight. Do you think, does this matter to the government, or do you think they might revisit this whole issue next time round?
Well, I think what's happened is good news for John Key. The first sentence of my column is John Key is the big winner from the Conservative Party meltdown. They did get nearly 100,000 votes, 96,000 I think last time. The Labour Party is not going after those votes because the Labour Party is more concerned with expelling people who they think are guilty of thought crime. If the Labour isn't content with being down to 25%, they're talking about expelling people that they still see as too right-wing from their party. So Labour's not going to go after these people. And so either they'll become non-voters or they'll go to National, or perhaps some even to ACT. So it's got to be good news in that sense for National. And John Key doesn't have to make this difficult decision next time about whether to support Colin Craig or not. He's not going to be tainted by Colin Craig. Labour won't be able to say, you think you're voting for Key, but you get Colin Craig in the cabinet instead. Colin Craig will be gone from the scene. This makes a fourth term for John Key more likely.
And that's our weekly hit with Matthew Hooton.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In crowdfunding news, the capital raised for Lance Wiggs' Puna Kaiki Fund has been extended as investments are juggled to get around the $2 million maximum raise allowed under equity crowdfunding laws. Although the snowball effect capital raise for the investment fund reached its $2 million maximum yesterday, it's been extended until Friday, along with the concurrent offers running to existing shareholders and private investors. Those who qualify for a private investor offer will be asked whether they will move their snowball investment over, opening up capacity for more investors to join the snowball offer. Mr. Wiggs says $150,000 has been moved today, with a potential for another $150,000 to be moved before Friday, depending on how demand goes. He said, "We're very happy with where we are, but thought we'd give people a little more opportunity. Typically, you have a handful of large investors and a long tail of small investors, so it was easy to identify who might qualify for private investment." Mr. Wiggs says one investor had invested in the snowball offer as well as private offer, which made moving that investment easy. To qualify for the private offer, a person must be an exempt investor as defined under the FM Conduct Act, which includes wholesale investors, high net worth individuals, close business associates and relatives. The minimum investment for the private offer is $21,750, whereas for the snowball offer and existing shareholder offer, it's $1,450. Mr. Wiggs says the combined offers are reaching $4 million, with $600,000 from the private offer and about $1.4 million from the option round, with scope for all those to increase. But is this legal? Well, the only other company to reach the $2 million crowdfunding maximum was wine company Envivo in March, and the year-old equity crowdfunding legislation does not cover the possibility of switching investments over to a private offer to increase crowdfunding capacity. A Financial Markets Authority spokeswoman says there are no defined steps set out in the regulations and legislation for this type of scenario. Depending on the circumstances, we would pay particular attention to whether the proposal is designed to circumvent the $2 million threshold for crowdfunding. She says the FMA would expect the provider to consult with them before considering doing this, but would not disclose whether Puna Kaiki or Snowball had been in touch. The $2 million maximum is currently a healthy limit, but in the longer term, Mr. Wiggs would like the FMA to consider extending it. He said it minimises the risk of people losing money when the limit is not too high. There are one or two equity crowdfunding offers that have gone through that I would say would be highly unlikely to meet their targets, so what happens when the fallout occurs? He said everyone is still learning how equity crowdfunding works, but in a year or two from now, a review should be done and the maximum raise amount should be on the table to look at. The FMA spokeswoman says changing the limits would require changing the legislation, and it's important to set limits to establish a level of protection for investors in this lower compliance regime. In market news, NZX is backing down on its demand for a near five-fold annual fee increase from some of its smallest companies. but it won't let those companies tell anybody, and NZX itself doesn't want to talk about it. That means the extent of the compromise reached is unknown, but several of the NZAX companies affected, those with a market capitalisation of less than 15 million, have told MBR Radio they're happy with the outcome. Nobody at NZX was available to be interviewed, but a spokeswoman said in a statement, "We're working closely with NZAX issuers and the conversations between the parties are confidential. We don't have further comment to make on this." The backdown comes in the wake of several of the affected companies, 13 in all, accusing NZX of abusing its monopoly position. The head of one company says NZX apologised to him. He says, "I got the impression that someone had made the decision fairly casually with no thought about it. Anyway, they were prepared to listen and we were happy with the outcome, but you're right, subject to confidentiality." The companies affected paid $5,375 last year and were given less than 2 weeks' notice that it was increasing to $15,000 this year. That meant there wasn't enough time for the companies to opt to delist to avoid the fee increase. Companies have to give at least a month's notice if they wish to delist, and they also need to get shareholder approval, so realistically the process would take considerably longer. It also entails substantial costs, including the $16,500 delisting fee. This year's fees are due on July 1.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
NBR Radio on Friday the 3rd of July. I'm Andrew Patterson. Time for our weekly macroeconomic roundup, and joining me, Jason Walls. Jason, let's start with the big story of the week, Greece. Take us through a week of pretty volatile action.
Pretty volatile is absolutely right. It's been a crazy week in Europe and especially in Greece. I'll start from, let's say, about this time last week, because you can actually break a situation like this down by the day. And I think, what day is it? It'd be Friday today. So what we were seeing last week is we were leading up into Tuesday, and Tuesday in Europe was the cutoff date for when the debt was due. So we were seeing Tsipras and his government still trying to implement reforms. So from there, they were all rejected. And then the reforms that the creditors were proposed to Greece, they just said, no, this is not good enough. And this forced a lot of volatility. We saw on Monday that stock markets around the world went haywire, essentially, and it was just madness, especially in China. And that's something else that I'll come to in a few minutes. And then Mr. Tsipras announced on Sunday that he was going to have a referendum for the debt and the austerity measures. So essentially what he said was that he was going to ask the Greek people if they wanted to adopt the austerity measures. And since then it's been extremely split on whether people are going to accept or people are going to say, oh, well, the vote is yes or no. Should we accept the creditors' offers? And some saying yes, some saying no. So it's not clear which side is ahead at the moment. Fast forward to Tuesday, no surprises. Greece defaulted on the debt. They didn't have any cash to pay the IMF, which means that the $16 billion, or euros, that the IMF had in reserve for Greece have been cut off, and they have just no way to pay any of the other debt. It's also worth pointing out that they've got a lot of pensions to pay, and they've got a lot of public sector wages as well. So it's a really dire situation from Greece. Right now, we're sort of in limbo as we wait for the referendum on Sunday. All creditors have stopped negotiations for Greece and said, we're not going to have any more conversations until the outcome of this referendum, which they're urging the Greek people to vote yes, please accept our credit, our austerity reforms. However, the Greek government is urging them to vote no. So it's a really, really bizarre situation.
And then this bizarre sort of capitulation on Wednesday night where Tsipras basically said after the fact, well, maybe we will just accept the bailout terms with only fairly minor modification.
Yeah, he's done this before. He's said, okay, we'll accept them if you do this and this and this. And then they've said, okay. And they've made modifications, but he hasn't seen them in line to what he is wanting. So, I mean, he said a lot of things. And he said on Greek television, he was outlining that it was like, doesn't matter what happens on Sunday, we're still going to be part of the Eurozone, which is, it's a lot more to come.
All right, so we watch for the result of Sunday's referendum. And of course, what's been overshadowing all of this is some quite big economic moves out of China. What happened this week?
Well, we saw over the weekend that China again dropped their interest rate, and that is for the fourth time in 6 months. So that's a huge easing bias. So they were on, I can't remember what it was, but it was quite high in December, and then it dropped and dropped and dropped, and now it's at a 4.85 level. So you compare that with New Zealand, and we're at 3.25, and it seems a huge amount above us, but I mean, they had rates. I mean, it's just been at a high level for ages, and they've been dropping it. So this points to a lot more stimulus within the Chinese market. We've documented well here on NBR Radio the Chinese slowdown, and in fact, at the beginning of the year, the GDP growth only grew 7%, which, again, if we look at it from New Zealand's point of view, that's huge, but for China, it's a lot less, and it's actually quite concerning for them. So they've been looking to add stimulus into the economy any way they can. They've cut taxes on some commodity goods. They've reduced rates, as I've said, and today, in the same announcement, they actually reduced the reserve requirement ratio for banks, which limits the amount of cash that they have to have in reserve. So the idea behind this is it spurs lending, as banks have to have less in so they can... Economics, complicated stuff, but it spurs lending. And it's the first time that China have actually cut rates and the reserve requirement ratio together since the global financial crisis in 2008. So that's quite a big red flag if you're looking at the country's growth, that they're looking to inject this much stimulus into the economy. And I'm currently writing up a story, which you can read on NBR Online at the moment, about how this is going to affect New Zealand. We've talked before that the slowdown like this is probably going to have a bigger impact on Australia, because the Chinese are looking to kind of soften their demand for raw materials such as iron ore and things like that, where Australia produces quite a lot. However, New Zealand, most of what we export to China is dairy and meat and things like that. And although there might be a softening of demand, it's nowhere near going to be as bad as it will be for Australia.
And finally, let's talk about a country that doesn't often appear in the headlines, and if it weren't for the week that was dominated by Greece and to a lesser extent China, this would have been the big business story of the week. Talking about Puerto Rico, some quite significant developments. I mean, it's actually talking about a repayment amount substantially more than Greece owes, which it's basically said it can't afford to pay.
Yeah, well, and as you quite rightly pointed out, it's been really overshadowed this week by the developments in Greece and in China. And I would have usually led with a story like this on the wrap up, but it's huge, $70 billion in debt that they have to repay, and the governor has essentially said that they can't do it, and they've been put in, his really interesting quote, a death spiral, which is, I mean, a governor is to use language like this, it must be really dire. And it's worth pointing out that the country has just 3.6 million people. So it's smaller than the size of New Zealand, but it's got this huge debt that just can't pay back. And most of the debt is owned by the US investors in things like mutual funds. So that means that a lot of the debt that's in there isn't even known, that the people that have the debt in there don't even know that it's there, because they just kind of give their money off to these sort of funds. And
Puerto Rico is a protectorate of the United States, I think.
Yeah. So that's why there's been a lot of chat around how this is going to affect the US as well. But yeah, it's the government couldn't keep borrowing money to address the budget deficit. So it can't ask residents who are already struggling with things like high rates of poverty and crime to shoulder more tax on this, because, it'll place more burden on the economy. If you raise taxes, that means there's less spending, and it could be ultimately worse. So this will be another one to watch, and to see how the IMF and other people, because they've asked for an emergency bailout fund, will react to something like this. Because the interesting thing is here, because you've seen Greece get all this attention and all this money from some of its creditors, but that's because it's in the Eurozone, and most people agree that they just don't want Europe to falter. If it was Greece by itself, it'd be a different story. And now we see a country which is by itself, which isn't attached to a union such as the Eurozone. It's going to be a very different story, and see how this plays out. It's going to be interesting.
One assumes we don't expect the US Federal Reserve to ride to the rescue of Puerto Rico.
No, I think they've got their hands full with the rate hikes coming up soon, which is, that's another interesting thing that's coming up in September, and we'll be talking a lot about that as well.
All right, thanks for joining us. Jason Walls on NBR Radio.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Court news. A substantial foreign exchange dealer and currency remitter is fighting back against Kiwibank's attempts to close its banking accounts and facilities, a decision that would probably end its business. Auckland-based eTrans International Finance, established in 2003, last week won an order from the High Court prohibiting Kiwibank from closing its accounts and facilities until further order from the court. And in the High Court at Auckland today, Justice Anne Hinton ruled the substantive matter should be heard at the earliest possible date. According to its website, which is mostly not written in English, eTrans is a well-known and respected foreign exchange company that provides the best rates and services. Its philosophy is to provide multiple and flexible financial services to new immigrants, international students and tourists through engaging in and facilitating local and international trade and contributing to the uninterrupted flow of peoples over international borders. The Chinese company operates on Auckland's Queen Street, with Companies Office records listing Xiaohua Sun as the sole director and shareholder. In March, Kiwibank told eTrans it was closing the company's accounts because it considered eTrans' business posed too great a risk to the bank under the Anti-Money Laundering and Countering Financing of Terrorism Act. eTrans has banked with Kiwibank since 2004. The Reserve Bank told the country's banks in January this year the legislation does not require them to take a broad brush approach against money remitters after some expressed concerns banks were indiscriminately terminating their accounts. eTrans had opened its most recent account with Kiwibank in early 2014, but was told the bank had had a change in policy over accounts associated with money remittance or money-changing services. The company started proceedings against the bank on March 31st, alleging breach of contract. eTrans is being represented by high-profile QC Jim Farmer, who indicates the hearing will require 2 weeks. But Kiwibank's lawyer Andrew Butler says it's keen to get the matter, which it thinks might only require a week, heard as soon as possible, particularly as it has to maintain eTrans accounts in the meantime. He says the case is likely to be of interest to all the banks. Justice Hinton says eTrans' proposed timetable, which suggested a fixture in February next year, is fairly relaxed. It doesn't need this matter to be heard in a hurry. She ruled the matter be given priority for a 2-week fixture at the earliest possible date. To Christchurch is Prime Minister John Key sending in Mr Fix-It Stephen Joyce to hurry Canterbury earthquake recovery Jerry Brownlee along. This is the view of Labour's Canterbury earthquake recovery spokeswoman Ruth Dyson. She says the new transitional agency announced by Mr Key appears to be just Sarah with a new name. Ms Dyson says, but the community is crying out for a new approach to get things moving. She said one of the slowest and most frustrating parts of the recovery has been the lack of progress under Sarah on the central city rebuild. Instead, Mr Brownlee has announced a new agency with much the same functions and approach. The announcement that MBIE will be picking up many of the functions of the residential rebuild is also an admission that progress has been too slow. Ms Dyson says chucking a new coat of paint on the same old way of doing things is no way to regenerate Christchurch.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to our weekly edition of Hindsight with Rodney Hyde. And Rodney, you seem to be taking a leaf out of Greece's book this week by calling for a referendum on taxes.
Yeah, well, I hope I'm doing it the right end of the problem compared to what Greece is having to do. And here's how my thinking goes. I've never understood really why we get so upset about local government and our rates compared to central government and our taxes. And people would come to my office and complain bitterly about rates. And you're looking at them and thinking, have you got any idea about your GST and PAYE? And of course, that's the point. The central government politicians have made PAYE and GST almost invisible and very painless. And yet rates are a cheque that we have to write to the council, and so we feel that pain. And for every dollar that we pay in rates, we pay $13, would you believe, to central government. And so central government increases its spending and no one even notices. And so what I suggested in my column this week is, yeah, we can vote this councillor in and that councillor in, but the ones that get voted in are always promising to spend our money, and anyone that stands up and says, look, I'm not going to spend anything, they don't get the vote. And so what I suggested to do is that every time we vote for a politician in a local body's election or in the central government, there should be a referendum on whether we want our taxes to stay the same, whether we want them to go up 10%, or whether we want them to go down 10%. And so we'd get the democratic power to calibrate the tax and therefore the spending. And funny enough, I think it would be fantastic. It would save the Greece scenario because people don't like paying taxes. And also it would get the turnout up because I don't really care who's mayor, but I sure as hell care about my rates. So that was my recommendation. Funnily enough, I took a proposal like that to Cabinet, and I got shot down in flames because the one thing politicians don't want to do is have taxpayers decide how much tax should be taken.
Because I guess the answer would probably be fairly predictable. The less the better.
Of course, the less the better, but they'd get to a point where people would start to say, I would always vote for less taxes, but they'd come to a point where politicians explained and said, look, we need this tax for this reason, and if the majority of people thought that was fair enough, they'd go along with it. But of course, we don't even get that say, and we should have that say because it's our money.
Because you're calling, I mean, in simple terms, you're calling for more transparency.
More transparency, more accountability, and the ability of people to say, not necessarily how the money's spent, we don't want to get down into that level of detail, but how much rates gets taken, how much PAYE gets collected, how much GST gets collected. We should have a say about that, and I particularly like it because I believe in less government, and I think people would always be arguing, like you say, for a bit less tax, not for a whole lot more.
Of course, New Zealanders are terribly compliant. We know that. They stick to the same old bank, the same old electricity company. They don't tend to kick up a fuss like our friends across the Tasman. So, you know, is there likely to be some sort of taxpayer revolt?
Oh, look, if we had to write a cheque to central government for our taxes, there would be a revolt. In fact, I put a proposal up to Parliament years ago and had the numbers to pass it. And Bill Birch, Michael Cullen decided to support me just to cause trouble, and Bill Birch had to pull a veto to stop it. And it was a simple requirement that the IRD Commissioner write to every taxpayer and tell them how much tax had been collected on their behalf and to thank them for their contribution. And I think if people realised how much tax was being taken off them, we would go to Parliament with pitchforks. And that's why GST, by law, is not allowed to be identified in the price of a good. No one knows what the tax is on petrol, and most workers don't know how much PAYE they're paying. And the politicians have gone out of their way to make that invisible, and so they don't have precisely that revolt. There would be a riot.
Of course, in Auckland here we have a very prominent agitator by the name of Penny Bright, who has for years been refusing to pay her rates because she says the council, Auckland Council, does not disclose the amount of detail she'd like to see, particularly in relation to contractors. I mean, she's a one-man battle going on, and then this is my point, really. Not enough people seem to get upset about these things.
No, they don't. And I've always been, Penny Bright's a extreme socialist, and I've never understood why she's concerned about government spending money, but I've always supported her, and she'll acknowledge this. She's always come to see me, and I've always helped her as best I can, because I think we need more Penny Brights in the world, not less. And actually, it's the people like that jump up and down that actually do create the attention, do create the accountability. And so I say good on Penny Bright.
Shifting the focus to the rates equation, Rodney, I've just received a letter in the post, as will have many thousands of Auckland ratepayers this week, giving me a heads up that my rates are likely to go up this year by between 20 and 30%. Obviously, I'm not too pleased about that, but what on earth can I do about it?
Well, nothing at the moment, but here's the point. The people of Auckland, and I mean, it's just that we're all hypocrites. The people of Auckland, we voted for a mayor and for councillors who promised to spend more money. They didn't present it that way. They promised that they'd, do the trains and they'd complete this and they'd provide for this boondoggle and that boondoggle. And so we have voted in a big spending mayor and a big spending council, and if the council's going to spend big, they're going to rate high. And so we've got exactly what we voted for, and that's my point about having that opportunity to have a referendum, because I can tell you if a politician stood up and said, look, I'm not going to spend council money, I'm not going to provide you with all these little goodies, I'm going to cut council to the bone and therefore get your rates down, funnily enough, that person wouldn't get elected.
And that's this week's edition of Hindsight with Rodney Hyde.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
In People News, Kiwi liquor industry executive Julian Davidson has quit as chairman and director of Lantern Hotel Group 10 days after assuming the chairmanship. In a letter to the board, he said he was resigning with immediate effect because his developing business interests in the US left him too busy to have time for Lantern. As reported by NBR Radio last week, Mr. Davidson has been hired as a consultant by New York-based Long Island Iced Tea Corp, a beverage company partly owned by NBR Rich lister Eric Watson. His decision to leave the Lantern board 10 days after his appointment as chairman on June 18 follows a shareholder coup on June 24, which ousted 3 directors, Brian Mogridge, Russell Naylor and Barbara Cartwright. The 3 were voted down because a majority of shareholders perceived them not to be independent of 34% shareholder Torchlight, a private equity fund controlled by New Zealand-listed investment company Pine Gold Corporation. Mr. Mogridge and Mr. Naylor are both directors of PGC, while Ms. Cartwright is said to have provided accountancy services to PGC Managing Director George Kerr. Mr. Davidson, a former chief executive of Independent Liquor, had urged shareholders to vote against their removal, saying he had full confidence in them and their ability to continue a turnaround of the company. Lantern operates 13 hotels in Australia, mainly in New South Wales. Let's talk green men. An ad campaign from Auckland Transport seeking to raise awareness about crossing roads safely has been labelled as creepy and patronising by a transport commentator. The Green Man campaign features outdoor advertising of pedestrians walking beside a green figure, as well as real-life interactive men in morph suits helping pedestrians cross Auckland's busy central streets. Auckland Transport created the campaign with the assistance from the New Zealand Transport Agency and the ad agency Work Communications. The council-controlled organisation says there were 50 fatal and serious pedestrian crashes in the Auckland CBD from 2009 to 13, 9 of which were on Queen Street or Karangahape Road. The campaign hit the streets this week and will run until the end of July and has a media spend of $76,500. Auckland Transport blog editor Matt Lowry told NBR Radio the campaign is stupid and places too much responsibility on pedestrians and not enough on drivers. He says it's not like people don't already know how to cross the road. Auckland Transport, he says, needs to have a look at why people are jaywalking, and we need to be building our streets to accommodate that rather than force everyone to cross at a signalled crossing. Queen Street has enough pedestrian crossings, he says, but many other streets don't, and people can be waiting for several minutes. The transport commentator says he's not at all impressed by the creepy morph suit men who ask people if they want help crossing the road. An Auckland Transport spokesman says a survey of Queen Street found 2,250 people cross the road away from the lights in just 1 hour, placing themselves at a higher risk of injury or death. The spokesman says observational surveys during the same hour also recorded pedestrians running out from behind parked cars into the street without looking, people dodging through moving traffic, walking out part way onto the road only to have to turn around and return to the curb, and other dangerous behaviour. He says the campaign's success will be measured by on-site research on Queen Street and K Road, as well as a focus panel. Auckland Transport says the total social cost of motor vehicle injury crashes in 2013, which includes injuries recorded by the police, hospitals and ACC, was estimated at approximately $3.14 billion at June 2014 prices.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to our weekly edition of Hunter's Corner with Tim Hunter. And Tim, you've been examining performance fees of fund managers.
Yeah, that's right. It's an interesting area, and it's obviously been a bit topical since my colleagues were looking at the performance fees and of Milford Asset Management last week. So I wanted to just have a little bit more of a look at the whole issue of fees for fund managers, and it's very, very interesting and quite complex, and there's almost no limit to how detailed you can get into it. So I was really only scratching the surface. But essentially, obviously, when you hire a fund manager, you're paying them money to do a job for you.
Management fees.
That's right, and that's fair enough. And if you like, if you were to pay a salesman, for example, to sell stuff for you, you'd give them a base fee and perhaps some sort of extra commission, which encourages them to sell more stuff for you. And that's really the way fund managers structure their fees, or at least some of them do, through these performance fees. So they have their base fee, which gets them a certain level of remuneration, and they have a bit extra on top if they do really well. It's not uncommon, although there are some fund managers that don't really like to do that. So that's the basic essence of it. But one of the things I noticed was an additional aspect of performance fees is the high water mark. And these are quite complicated to describe in disclosure documents because they are supposedly designed to prevent a fund manager, earning a performance fee for merely recovering past losses. So, for example, if you've got a fund that's worth 100 million and it drops to 90 million and then gets back up to 100, it really is supposedly not really fair to get a performance fee for recovering money that you lost earlier. So for getting the gain from 90 back to 100. So that's what high water marks are designed to do. But basically the analysis of Milford suggested that they've got a structure which does seem to allow that to happen. And I was quite surprised by that.
So what about underperformance? What happens then? I mean, are there any penalty arrangements?
You can get that. There's a kind of fee called a fulcrum fee, which is common in the US for mutual funds, and I think it's actually mandatory for mutual funds in the US. Under that structure, there is a fee of 1% management fee, and then there's a performance element by which can be plus or minus an extra amount. So if they perform well, they get the extra, and if they perform poorly, the management fee actually goes down to, say, 0.8%.
Which sounds fair.
Yes, you could argue that is indeed fair. And there are some funds in New Zealand that have that. There is Fisher's listed investment trusts do have a form of fulcrum fee. And although I gather that one of the reasons it's not common in the unit trust space is that it's very difficult to calculate and to administer because of the open-ended nature of unit trusts. That's the reason for it. But otherwise, you'd think it would be much more attractive, at least for investors, to see that.
You're listening to Hunter's Corner with reporter Tim Hunter. Now, you have talked to a number of players in the game, including BNZ's Wealth Managing Director John Boddy. Where do the BNZ stand in all this?
Well, that would be ANZ. We should.
My apologies.
Yeah, they've got a different position on it. They say that they don't charge performance fees. They say that investors pay them, the standard fee, and if they, it's up to them to do the job properly for the money that they get as the standard amount. And that's certainly a reasonable position to take. You could argue that there's enough incentive already built in there because the more funds they manage and the more gains they make, the bigger their fees just under the standard process. And that's perhaps a perfectly normal way to do it. And one of the things you find with these fund managers is that they all have quite firm and strong views on the way they charge funds as being the best, and their other guys are somehow not doing the best for their investors if they charge a different structure. I think that you can understand why they take that view, but I'm not sure that there really is a single best way to do it. For example, there's a lot of controversy over the use of benchmarks. Now, an actively managed fund investing in equities might say, oh, well, we were trying to outperform, say, the NZX 50. You could argue that's fair enough because they're taking a certain amount of risk by investing in equities. But that does allow them to potentially gain performance fees for a negative performance as long as it's better than the index. Other fund managers say, well, we may be investing in equities, but our investors pay us to make money for them, not to lose money for them, and therefore we're only going to take a performance fee, if we're getting positive performance, which is an absolute returns type of fund. And I can see the logic of both those positions, and I think in the end of the day, it's really up to investors just to choose the structure that they prefer.
Getting back to Milford, which is obviously getting perhaps a lot more scrutiny than it might otherwise have got in the past,
yes.
which is fair enough given its scale. What have they got to say about their performance fee structure?
Their position is that their fee is fair and popular, and indeed investors have certainly had no trouble tolerating it so far. They've been a very popular fund manager among investors for quite some time. In more detail, their fund has as they call it, quite a low basic fee, and they contrast their position with others in that they don't charge extra for all the fund's expenses, like brokerage or whatever. That is included in the base fee that they charge. And so in the end, the argument is that they have more lower fees overall than other funds. I think they can argue that. The trouble with a lot of the New Zealand fund management industry is that the transparency from an investor's point of view on fees is very low. So it's very hard to compare one manager with another in terms of the fee structure and its costs effects on the funds. And it'd be really nice to see a more, comprehensive and regular way of measuring that, so that it will allow investors to see a management expense ratio that could be easily compared one to another.
So how do you think we might go about achieving that greater transparency and disclosure, Tim? I mean, you look in the paper and you see all these facts and figures on a weekend of how funds are doing. I mean, it looked to me like a minefield at first blush. I mean, how do you simplify it down to something that investors can relate to easily?
Yeah, it can be done, and it's certainly done overseas. And there are moves to achieve a management expense ratio type measure with New Zealand funds, as I understand it, but it doesn't seem to have caught on in any kind of comprehensive way, and I think it'd be nice to see that developed.
Well, my thanks to Tim Hunter, and that's this week's edition of Hunter's Corner.
NBR Radio. Free to air online with business news you can use.
To forestry. The president of the New Zealand Forestry Institute is calling for National to take the industry seriously and provide input to the formation of the New Zealand forest policy. James Treadwell says the national government does not take forestry seriously. We are the third largest export earner for the country. He says when his organisation approaches Primary Industries Minister Nathan Guy, it's always redirected to the Associate Minister Joe Goodhue, who is not in Cabinet and who doesn't understand the issues around forestry. Mr Treadwell says people are moving away from us when we could add so much more to the country if only the government started listening to us and taking us seriously. Ministry for Primary Industries, or MPI data, shows forestry exports for the year to June 30, 2014 were worth $5.13 billion. However, according to MPI, this amount is expected to decrease until 2018, the year the ministry's situation and outlook forecast extends to, even though this is when most of the much-hyped wall of wood, that is commercial forestry planted in the early mid-1990s, matures. Mr Treadwell says we're in the process of forming what we call the New Zealand Forest Policy, which is intergenerational and planned out for the next 100 years. What we want is the government to come to the table and start talking with us about the formation of that policy. Secondly, we want acknowledgement from the government that there are inherent subsidies for some land uses and the government has imposed costs for other land uses. Mr Treadwell says the Institute, which has about 900 members, believes the development of an integrated land use policy needs to be urgently addressed by the government. In business news, NZX-listed Fletcher Building has more than $2 billion worth of work in its pipeline and has plans to raise about $550 million from asset sales. Much of the work underway includes developing sections and houses to alleviate Auckland's housing shortage. Fletcher Building executives gave a bullish presentation in Sydney recently, outlining rising construction and plans for $550 million in asset sales. Even so, the share prices continued to ease in recent weeks from $8.31 in May to $8.10 last week, in spite of a survey of analysts giving an average target price of about $9. A backlog of work is rising and expected to continue peaking after the end of 2015 to nearly $2.5 billion worth of work, with more expected. In New Zealand, earthworks are underway at Peninsula Golf Course in Rodney and have been completed or underway at West Auckland sites at Penihana, Whenuapai and Hobsonville Point. The company is building homes on the North Shore at Greenhithe, while new opportunities are at preparation stages at Stonefields and Three Kings. In the south and east areas, development opportunities are being advanced at Ormston and earthworks are underway at Beachlands. In South Auckland, Fletcher's has re-established work at Wattle Grove. The Manukau Golf redevelopment will be ripe for sales in 2018, and stages 4 and 5 of a development are underway at Karaka. The other main, albeit much smaller focus for residential development is in Christchurch, with 5 main areas where Fletcher has projects, including the Farrington development at Horswell, 90 homes at Rolleston, and partnership deals with the government and council on 2 central city sites and 1 fringe city development, totalling 128 properties, with another 1,000 classed as confidential. The company has 2,708 sections under development throughout the Auckland area, plus housing developments underway for 2,893 dwellings. Quarterly payments from the sale of the housing developments underway are forecast to hit $46 million in September 2015 from various developments. Big construction projects over the next 2 years include the Auckland Convention Centre East Prison upgrade, 2 Auckland University buildings, the Wellington Hotel and Convention Centre, and rebuild projects in Christchurch. Roughly half the most profitable work over the past 3 years, based on earnings before interest and tax, has come from earthquake residential repair work, with a similar amount from infrastructure and smaller amounts from commercial building. The planned $550 million worth of asset sales include Rockler Quarries, its half share in Sims Pacific Metals, Fletcher Aluminium, Tasman Sinkware and Fletcher Insulation. The presentation also included information about performance of Fletcher subsidiaries such as Placemakers. In Australia, the Fletcher executives outlined the turnaround of fortunes in the plumbing supply subsidiary Tradelink and the performance of the 7 businesses in the trade supply sector in New Zealand: Placemakers, Foreman Building Systems, Easy Steel, Myco, Pacific Coal Coaters, Cyclone and Fletcher Reinforcing. Recent earnings guidance forecasts are at the lower end of the $650 to $690 million range.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to the political and economic week that was with Rob Hosking. And Rob, kicking off with politics, the big talking point this week, the selection of a deputy leader for New Zealand First.
Yeah, the election they refused to tell us about. It was all very strange. There was the rumour swept Parliament on Wednesday that the New Zealand First had perhaps elected a new deputy leader, but if they were, they'd decided to keep it very quiet. And it was all very, and not even comment on it. It was all very strange, and it certainly got the attention. But frankly, even when they elect a pope, they send up smoke signals, and there weren't even many of that from New Zealand First, even though Winston Peters, as no one can puff away like a chimney at times. It was all very silly. But anyway, this morning we finally had confirmed what the rumour mill had been telling us for 48 hours, which is that Tracy Martin, who has been the deputy leader of New Zealand First, didn't get re-elected, and the new deputy is Ron Mark, who came back into Parliament at the last election. He was a New Zealand First MP back in the 90s and through till they lost their seats in 2008. And since then, of course, he got elected MP for Carterton.
Winston Peters must know more than anybody else that the less you tell the media, the more they want to know. Was this just a ploy on his part to attract attention to the issue?
Oh, it probably was. Look, fathoming what motivates all this sort of fairly childish, frankly, carry on, I don't know anymore. and there's a small part of me that just doesn't care. Look, but that said, there's a bigger sort of game afoot here, and it's not just about New Zealand First. Winston Peters turned 70 back in April, and he's probably got one more election in him, and there are constant rumours, of course, that he won't even fight 2017. He's now got an electorate to look after.
He'll be exhausted after that, yeah.
Yeah, and there is the perennial rumour that Shane Jones will be parachuted in to stand for that electorate in 2017. Of course, Shane Jones is also a native Northlander. Look, again, that is something that I keep hearing. The Shane Jones ploy has become such a perennial rumour that no one can trace it, and it's personally I'm quite suspicious of these sort of insider bits of received wisdom because they tend to just be repeated and repeated and repeated, and no one actually checks them out. And whenever you do check this out, you hit a blank wall. So it may happen, it may not. I have my doubts because I think Shane Jones is also starting to get to a point in his life where we would rather not have the huge workload of running an electorate seat and leading a political party. You've really got to have your wits about you there. And also, if he gets parachuted in, then, and this brings us back to the deputy leadership race we've just had, there's going to be a lot of people, two in particular, who are going to be, existing New Zealand First MPs who are not going to be very happy about that. So I just can't see how that scenario can play out. The other part of the wider thing, of course, is the Conservative Party implosion in the last fortnight, and a lot of that is about pitching for the post-Winston vote. Really, the opposition parties, and I'll include Labour here, are starting to look a lot more closely at what a post-Winston Parliament might look like. And because Winston Peters, although, if you're going to look for major policy contributions to New Zealand public life, you spend a long time looking once you get past the gold card. There just isn't a lot there. There's been a heck of a lot of sound and fury signifying very little for the 30-odd years he's been, more than that, he's been in politics. Sure. But he's been a real weather maker, and we're going to, at some point in the next 3 or 6 years, going to have to learn to get along without Winston. And that is actually going to change the dynamic of our politics quite a bit.
Moving on, I understand the government's been firming up its property tax proposal.
Well, this is the stuff that was announced in the budget, and we have a piece in print in the print edition this morning where we got hold of some briefings within the Inland Revenue before these things were announced. There's two things that stand out. This is the Bright Line test and the de facto register of foreign investors. The Bright Line test is the thing that basically says if you're buying and selling property within 2 years, it's going to be deemed part of your, the capital gain will be deemed as part of your income, and you'll be taxed on that, regardless of, whatever. It's just, that's the way it is. Boom. That means there's a couple of things there, and I'll look at that Bright Line thing first. The first part about that 2-year test is, and there was some criticism that, look, it's only 2 years. Treasury wanted 5 years. But even so, what that does is takes that 2-year buying and selling period out of the area where the IRD has to try and prove that you intended to sell it for a capital gain. It's just deemed that way by law now. So the enforcement activity, and they've got more money to spend on that enforcement activity as well in the budget, doesn't have to go to that stuff. It now will move up to the longer held bits of property, and they're going to be able to put a lot more audit activity into the 2-year thing takes care of the low-hanging fruit. This is good. They'll be able to focus a lot more of that audit activity on the high-hanging fruit that they might have had to leave alone in the past. So that's going to make a difference to the whole dynamic of property investment and the tax issues around that. The more important thing is that is the impact of foreign investors in the market, and this has long been a subject of rumour and innuendo and often some quite racist comment. What I found interesting about the briefings, which haven't been released anywhere else, that I got hold of, is that IRD has been saying we think there's a lot bigger impact of foreign investors than we thought, and quite a bit of that impact is masked. It is being happening under the radar. There's been a lot of stuff going on that we just don't know about, and then now, because the new rules basically say if you're an offshore buyer, you've got to register the ID, you've got to have a New Zealand bank account, and basically you pay withholding tax up front, and you've then got to make a case to have that back as a tax deduction. And I would imagine quite a few won't bother to do that. So this is shaping up to be a bigger deal, particularly on the foreign tax, on the foreign investor side, than perhaps it looked like 2 or 3 months ago, 3 to 6 weeks ago.
You're listening to the political and economic week that was with Rob Hosking, and turning to economics, Rob, the Kiwi dollar just keeps on plumbing new depths.
Yes, headed below 67 cents US on that particular cross rate. The other thing is that on a trade-weighted index basis, which is that's the basket of currencies of our trading partners, it is, as of last night, it's 6% below what the Reserve Bank thought it would be for as an average for the entire current quarter. Now, that's not minor. And what that means, amongst other things, is that although obviously that is going to help our exporters a lot, and that's long awaited. We've been told for 2.5 years now that, and we've been told correctly that our exchange rate is overvalued and unsustainably so. It is now heading back down again. But what that is also going to do is push up the cost of imports. And if that feeds through into bigger price inflation than was expected by the Reserve Bank when it started cutting interest rates a month ago, then you've got a bit of a different dynamic happening here as far as how far the Reserve Bank is going to be able to go with those interest rate cuts. And I know the overnight index swap market's priced in, well, certainly going to be one more cut, and it's probably going to be at the end of this month instead of in September, which is what it looked like earlier. But how far they're going to be able to go beyond that is going to depend on two things. One is how far the dollar falls and whether that starts fueling inflation. And the other thing is if growth starts coming off rapidly, then yes, they're going to be able to cut interest rates more, but we actually don't want that to happen, obviously. And we're getting economic policy, there's a lot of different balls in the air at the same time. But what it's starting to look like is, and we'll have a better picture for the outlook probably at the end of next week, because there's two big forward indicators coming out next week. But if growth starts looking like coming off really quite substantially, then yes, they'll have room to cut. But obviously we don't want growth to come off that substantially. And that's going to be a function of how far the commodity prices, well, milk, dairy price continues to fall, how far non-milk commodities hold up, and meat has been doing reasonably well. Tourism has been doing quite well the last season, and the dollar will help tourism. So, there's a lot of different things in the mix here, but I think people expecting that the Reserve Bank is going to keep cutting. I wouldn't take that for granted just yet because of that inflationary pressure that is going to be coming through on the other side.
And that's the political and economic week that was with Rob Hosking.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In business news, Tuatara has teamed up with 4 other craft beer brewers to collectively develop their exports. The company's chief executive, Richard Shirtcliffe, who calls himself head boy, says he was watching a container being loaded with a few pallets of Tuatara beer and a few pallets of several other beers, all paying pallet rates for their exports, and thought there had to be a better way. He decided to bring the different brands together to save costs and to coordinate their marketing efforts. The collective has been operating 6 months now and includes Yeasty Boys, Renaissance Brewing, 3 Boys Brewery and 8 Wired Brewing Company. He likens the concept to the way New Zealand Sauvignon Blanc wine was marketed in the UK in the 1990s, in which a suite of different best of New Zealand wines were offered together. Mr. Shirtcliffe says there were 2 conditions for entry into the collective. The companies needed to be able to supply, and we had to be able to invite them around to dinner with the wife and kids. If the parties couldn't get on with each other, the collective wouldn't work, he says. The collective has reduced freight and other logistics costs, and the group has a marketing representative in the UK to interface with retailers, taking a portfolio approach of offering the best and brightest in New Zealand beer. Mr. Shircliffe wouldn't say how much his company has saved through the collective, but says it's helped boost exports significantly. Last year, for the similar market of Ireland, Tuatara had been exporting a 20-foot container every 3 months to an in-market marketing partner. With the collective, Tuatara had aimed at exporting a 44-foot container every 2.5 months, but it's currently sending a 44-foot container every month, and that's not sufficient now. In business news, retail magnate Rod Duke knows he's probably going to have to win the hearts and minds of retail investors if Briscoe Group's bid for Kathmandu is to succeed. And he's not going to let his 2-year personal involvement with the flailing children's clothing chain Pumpkin Patch give opponents ammunition to attack him over. Not that that concerns him greatly, because Briscoe's and Rebel Sports provides more than enough evidence he and his team are capable of taking Kathmandu and lifting it out of the blind spot it's currently in. He says, to be fair, nobody knows what my real involvement at the coalface of Pumpkin Patch has in fact been. Mr. Duke says when asked about his shareholding and directorship for the past 2 years at the struggling company. He says, all I can point to is our experience at Briscoe's and Rebel Sport, and I don't think anybody is going to be punching any holes in that one. Briscoe's takeover of Kathmandu, tabled yesterday, is likely to attract some opposition, however, with some already labelling it hostile and opportunistic. But the ease in which Briscoe built its current 19.9% stake, with as yet unidentified institutions taking up Briscoe's off-market $180 a share pre-bid deal, suggests investors are not happy at Kathmandu's future under its current setup. Shares in the outdoor equipment and clothing chain have hit all-time lows after its half-year loss, and after it lost its previous chief executive, Peter Helkett. Briscoe's bid arrived the day after new chief executive Xavier Simonet started his job. Kathmandu has engaged investment bank Goldman Sachs as its defence advisor. Goldman Sachs Asset Management is the retailer's largest shareholder with a 12.3% stake. Briscoe's mainly scrip offer amounts to $180 per Kathmandu share, based on $288 per Briscoe share, and gives an enterprise value of $418.2 million. Mr. Duke's holding of the enlarged group would shrink to 55.1% from about 80% of Briscoe Group, ensuring the retail executive retains control.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to Media Watch with David Cohen. And David, you've been taking a look this week at Radio New Zealand's coverage of last week's bloodbath in Tunisia.
Yeah, I seem to have spent half my life following Radio New Zealand. Radio New Zealand's moaning report, as the NBR satirically sometimes puts it. And the part of this week's column that has to do with national radio turns on that subject again. We, as everyone unfortunately knows, a week ago today, there was more fanatical violence in North Africa, in Tunisia. 39 people lost their lives, most of them British tourists, in the immediate aftermath of 5 minutes of bloodletting by a Muslim extremist. That's been covered around the world. We know, of course, that coverage was precisely what the perpetrator was after, and that he got. What struck me quite forcibly this past Monday was that if virtually all the media outlets in the world that covered what happened in Tunisia, only one that I could find seemed to take the position that the man responsible for the bloodletting was in fact merely an alleged gunman, a suspect in the slayings, but beyond that we couldn't say anything too definitive. So that's the drum roll that introduces the column.
The fact that Radio New Zealand described the shooter as an alleged gunman, isn't it just pussyfooting around?
Yeah, it is. And it raises an interesting question. Either Morning Report is in possession of vital information unknown to the rest of us, or it's possibly simply engaging in the kind of, politically correct sleight of hand that has long been associated with that show. If the latter is the case, and I suspect it is, the timing is significant because, as we know, Radio New Zealand is currently reviewing a number of its flagship news operations, including Morning Report.
You're listening to Media Watch with David Cohen. David, of course, Morning Report was revamped 18 months ago, and there have been a number of changes with their programming and their personnel through the afternoon, and yet the ratings are continuing to decline.
Yeah, the revamp of Morning Report, I guess that's 17 months ago. Initially, I was pretty optimistic about it. In the Media Watch column over the years, I've been somewhat critical. Ultimately, what I'm critical about doesn't matter, but that sense of despondency about Morning Report has historically been reflected in ratings that could always have been a lot better. When Jeff Robinson retired last April last year, the organisation took the opportunity to really give it some adrenaline, if not testosterone, and so we've had Guyon Espiner and Susie Ferguson at the helm. I think they're pretty good. Guyon Espiner, well, they're both very smart. Guyon Espiner is somewhat weak on the vocal front, or on the timbre front, I think. His voice could do with some work. But he's a very smart operator, great journalist, and terrific interviewer. Susie Ferguson's got a much better voice. In a way, her problem is that her voice is perhaps a little too good, because the Scottish accent would sound, I think, in some ways more at home on the BBC, and she is of that professional quality, rather than a New Zealand public broadcaster. Even within the organisation, I know that it was felt, for instance, that having Susie Ferguson broadcasting from Gallipoli in April was probably a mistake on that front. And I'm not undermining her or taking away anything from her many talents. It's just that public broadcasters need to sound indigenously like the country they represent. Morning Report doesn't have Arab-sounding presenters. It doesn't have American-sounding presenters. Pardon me. It doesn't even have Polynesian-sounding presenters. And I think that also there is a little bit of an issue with her on that front. But more than any of that, it's the content of what they're doing that I think is the problem. I wake up to Morning Report every day, and I listen to it on demand as well. And it's a very left-leaning view of the world. Its obsession with trade unions and teachers' groups, and its notion of the universal order is, I think, just a turn-off for many people.
You've also written this week about Bauer Media's search for a new editor of Metro magazine. Yeah,
Bauer, of course, are referring to their search as being not for an editor, but a sort of brandmeister. In your journalistic experience, Owen, have you Have you ever heard of editors referred to as sort of branders-in-chief?
No, it's a first. Yeah.
It's a funny ad. I think that Bauer Media have used the word brand at least 6 or 7 times in this rather brief advertisement for the editor's position at Metro. And if that's their sensibility, their editorial sensibility for one of their flagship current affairs publications, as it used to be thought of anyway, then I would predict A, the response is not going to be vast, and B, the future for the successful brander-in-chief is not going to be rosy.
And that's this week's edition of Media Watch with David Cohen.
NBR Radio. Free to air online with business news you can use.
Back to the copper lines decision today. The Commerce Commission's latest decision not to backdate changes to its rulings on copper telephone and broadband line prices will mean telco retailers get to keep about $57 million, but will have to pay lines company Chorus something less than $864,000 a year more than the regulator's last draft ruling. That's because the corporate regulator has raised its regulated price for copper wire services to $38.43 a month, 4 cents more than its last ruling in December. But overall, the tiny change in pricing is a win for Chorus because it's $3.99 more than the Commission's original benchmarking decision in November 2013. That original decision, or $34.44, is what the retailers have actually been paying since December last year. However, this still isn't the final decision. That's not due until December. The largest telco, Spark, estimates that if today's decision stands, that it will cost it about $42 million a year more than it's currently paying. Naturally, Spark Managing Director Simon Muta says he's disappointed with the decision and continues to argue wholesale line charges in New Zealand are about 70% higher than in comparable countries. Spark had been running an email lobbying campaign called Be Counted to try to persuade the regulator to lower the price of copper services. Telecommunications Commissioner Stephen Gale says his organisation welcomed Spark's campaign and says it looked very carefully at international comparisons but concluded it costs more to install telephone lines in New Zealand. That's largely because New Zealanders are far more dispersed than people in European countries. Trenching costs 63% more in New Zealand than in Sweden, and it takes 26% more cable to connect the average New Zealander than it takes to connect the average Swede, according to Mr Gale. Mr Muta welcomed the decision not to backdate, something the Commission previously foreshadowed. That caused Spark to raise prices of most of its broadband and landline charges in February. Mr Muta says if the Commission confirms the decision not to backdate in its final ruling, Spark will honour its commitment to return that windfall to customers. But he's warning that if the Commission reverses that backdating decision, that will put more upward pressure on retail prices because Spark has only partly recovered the increased charges so far. Let's talk debt. Borrowing is on the climb. Private debt figures compiled by the Reserve Bank show borrowing for housing rose more than $1.5 billion in the most recent month. In dollar terms, the last time the increase was this large was November 2007. It's also close to double the average monthly increase of $882 million for the previous 12 months. The surge appears to be the result of borrowers getting in before the planned new loan-to-value ratio rules, which the Reserve Bank announced in May, but which will not take effect until October. For the year to May, borrowing for housing rose 5.4%. In May, it rose 0.7% on the previous month, the largest monthly increase since 2008. Although a long way below the 10 to 16% annual increases seen between 2003 and 2006, it is still a slippage of what has been a period of sensible restraint. The question is whether this represents a temporary spike or an abandonment of post-global financial crisis prudence. Although debt began rising again after a flat period in 2012, it was not increasing faster than the rate of nominal GDP and was therefore falling in real terms. The debt mountain is still large, and there appears to be an element of prudence fatigue among New Zealand households. The combination of low interest rates and a housing frenzy in Auckland appears temporarily or not to have caused a junking of previous caution. That's also seen in the rise of consumer borrowing. Combined with borrowing for housing, it means total household borrowings are up 6.3% for the most recent year. Elsewhere, the picture is more prudent. Business borrowing, which has been restrained despite the 2011 to 14 surges in business investment, has been low. That fall backs up the fall in business mood signalled in yesterday's ANZ Bank Business Confidence Survey.
NBR NBR. NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio and Talking Motoring with David Linklater, our car talk, the new government limousines. David, presumably you got a chance to drive one. How do the ministers enjoy it, do you think? How did it work for you?
I think they enjoy the current ones, which are BMW 7 Series vehicles. The big news with the government limousine fleet is that they're about to turn them over. So they're going through the process of selecting the new ones at the moment. Fairly secretive, actually. There are a number of potential choices. Car makers and the government are very quiet about which cars those are at the moment. They're all being chosen under the all-of-government contract process, which the old one actually expired on June 30, so this is a brand new regime. The way it works is that there are a number of car brands that are approved for government purchase, and the Crown limousines will be chosen under this. So at the moment, the brands in the frame are Toyota, Holden, Ford, Mazda, Hyundai, Mitsubishi, Suzuki. Now, there's no real contenders for a government limousine in that lot, but the government has said that they're also talking to 2 additional brands about Crown limousines at the moment.
And what are the actual choices, or how are they being weighed up?
There's a procurement office, and there is a centre of expertise for each AOG contract. So there'll be a government department looking very closely at all the possible Crown limousines. Beyond that, it's a bit of guesswork, but I'm happy to do some guesswork. Someone who should know has told me that that Jaguar, which of course has the XJ limousine, they've been ruled out. Audi's been ruled out with the A8. That leaves some possibles. BMW is a no-brainer, obviously, because they're already in there, so they'll be looking very closely at that, and they'll be pitching hard for that business. I think the other obvious one is Lexus. I know that they've been interested in the past with the LS600 limousine, which is a hybrid. And I think the other potential actually is Mercedes-Benz, because there's an S500 plug-in car available. So they would be my 3 picks. The government have said they're only talking to 2 additional brands. I don't know whether Lexus is included under the Toyota umbrella or not, in which case they could be talking to all 3.
And of course, the thing with the choice is it comes down to a very small number of potential manufacturers, doesn't it? Because it has to have a little bit of prestige value, but you don't want it in the Ferrari league.
You don't, and there's obviously a lot of resentment out there about government ministers riding around in what people perceive as prestige cars. I think the reality is the cost of ownership for the government and the taxpayer of a lot of these prestige cars is actually significantly lower than the old Holdens and Fords that they used to tool around in. The current fleet of 7 Series diesel cars is extremely fuel efficient. And of course, it's incorrect to look at the list price in New Zealand of one of these cars and think, well, that's what the government's paying. Of course, they're not. All of these manufacturers do special government models. You'll find that these Crown limousines have got a lot of equipment that's essential for a minister who's on the move, but a lot of equipment that's not necessary. You know, you might look in the boot of one of these things and find that it's got no lining in it. You know, they really just concentrate on the essentials. They're done at very special prices for the government, so you know they get good deals on these fleet cars for sure.
How prestigious is it for the brand to actually have this? I mean, that really, because they don't make any money on the deal. They do such a sharp deal for the government. There's not a lot of margin in it for them, is there?
There's not. There is a lot of prestige, though, obviously, in having your brand chosen for a government fleet. I'm sure that these companies will be pitching their vehicles based on a number of factors, including technological advancement, fuel efficiency, all that sort of thing. The current fleet of BMWs obviously getting to the end of the model cycle of this particular model, but there's a new series, 7 Series, on the way later this year. I would imagine that they'll be looking very closely at that, and that's a very advanced car. It's got carbon fibre construction. It's got things like remote parking. There's also a plug-in hybrid version available, and there's a lot of interest in plug-in vehicles in New Zealand. Obviously, it'd be great for the government to be driving those. Mercedes-Benz too have a plug-in S-Class available in Europe. That would certainly tick a lot of boxes for the government. And naturally, the Lexus is probably familiar to a lot of people. It's been around for a while now, but that's a hybrid vehicle as well. So not a plug-in, but a petrol-electric hybrid.
And just finally, Dave, what about the second-hand market for these vehicles?
I think they're fairly sought after. The initial fleet of 7 Series vehicles, which was purchased in, I think, 2008 by the Labour government, that was turned over after 3 years, and they were actually quite sought after and fetched quite good prices because they're long-wheelbase diesel 7 Series vehicles. So I think the depreciation of those cars based on the purchase price, and none of us knows what that is, but it would be very, very attractive, I'm sure. I think the cost of ownership of those cars for the government would have been extremely low.
David Linklater with us on NBR Radio.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the Christchurch Convention Centre. The delay in the government's promised convention centre for Christchurch is in deference to the $600 million expansion and rebuild of the city's hospital facilities. Our reliable NBR NZPI sources confirm the reasons given to property managers at a meeting of state sector property managers in Christchurch a few weeks ago. The property managers were told the delay was to ensure the most competitive pricing for one project at a time. Put another way, it's better to have 10 bees or construction firms buzzing around one honeypot, the hospital rebuild, than having 10 bees hovering around 3 honeypots. According to this explanation, putting out major projects for tender one at a time means firms will compete more sharply with each other, keeping prices constrained. In any case, the delays will ensure a longer pipeline of work if the convention centre goes ahead at all or in its original design. The government has already spent $77 million buying the land for the centre and more than $7 million on design fees. Work on the convention centre was scheduled to be underway in late 2014 with completion near the end of 2017, according to the Prime Minister John Key when he launched the rebuild blueprint at a gala function in mid-2012. In response to numerous media inquiries, Canterbury Earthquake Recovery Minister Jerry Brownlee says the centre is unlikely to be completed by the end of 2018. Neither Mr Key nor Mr Brownlee will explain the delays or discussion tensions. 3 years ago, the price of the convention centre was calculated at $284 million to be paid by the government, but details about operating costs and ownership have never been determined. In response to an Official Information Act request for the business case at the beginning of 2013, the Canterbury Earthquake Recovery Authority provided hundreds of redacted pages of reports. The Ombudsman is still working through a complaints process 2.5 years later. Back to Briscoe's. The Briscoe Group's takeover bid for outdoor equipment retailer Kathmandu is below par, according to Forsyth Barr. Briscoe, which is 80% owned by Rod Duke, launched its full takeover of Kathmandu yesterday afternoon after telling the market on Tuesday that it had acquired a 19.9% shareholding, mainly through buying out institutional shareholders at $1.80 a share. The well-performing retailer, which operates the Briscoe's Homeware, Rebel Sport and Living and Giving stores, is offering $89.7 million of its own shares and $32.3 million cash for the 80.1% of Kathmandu it doesn't already own. The offer is 5 Briscoe shares for every 9 Kathmandu shares plus 20 cents a share, which at current prices, Briscoe's at $2.80, works out at $1.76 or 4 cents below what was offered to institutions. Forsyth Barr retail sector analyst Chelsea Ledbetter says in a research note released this morning, the proposed takeover offer is materially below Forsyth Bid's value range of $189 to $250, using Australasian retail sector merger and acquisition transaction multiples. She says while the 2015 financial year valuations for the proposed takeover offer appear attractive, this reflects suppressed earnings and is not reflective of the earnings potential of Kathmandu. She said, we see this as an opportunistic move by Briscoe given the suppressed nature of Kathmandu's share price following weak earnings results. We see limited synergy opportunities between the two companies. We do not expect the proposed bid to be successful on the currently disclosed terms and do not expect Kathmandu's board to support a takeover offer at these levels. Forsyth Barr expects Briscoe will have to raise its proposed bid and possibly offer more cash to be successful. Its share price slumped in January after a profit warning, a weak outlook for the year ahead, and at the time there was speculation over who would launch a takeover bid. However, Forsyth Barr believes it can recover from the weak trading period due to its strong brand, market-leading position and vertically integrated model. On the other hand, a Morningstar analyst thinks Kathmandu could benefit from new management. The analyst says management could turn around Kathmandu's flailing operations by closing down underperforming stores, reinvigorating existing stores and investing in the brand. Kathmandu will benefit from adopting Briscoe's best practices, he says, albeit before the offer price was announced. Under Mr Duke's leadership, the retailer's shares have climbed 130% in the past 5 years as he drove sales growth at his homeware and sports goods stores. He told NBR News editor Duncan Bridgman he was confident he would conquer Kathmandu and waved away suggestions of a hostile takeover. Kathmandu has engaged investment bank Goldman Sachs as its defence advisor. Goldman Sachs Asset Management is the retailer's largest shareholder with a 12.3% stake.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebrett.com. NBR Radio.
This is NBR Radio on Friday, June 3rd. I'm Owen Poland, and I'm joined by Paul Adams, the Chairman and Chief Executive of EverEdge IP, which is helping businesses capture innovation and transform them into commercial successes. People might remember Paul through cutting his teeth at Brunswick New Technologies, formerly Navman, and also the manager of the Icehouse. And Paul has co-authored an insightful article about the opportunities that arise to salvage intellectual property when startups fail. Interestingly, the article highlights the fact that globally around 120,000 businesses fail every day. And of all the new businesses in the United States, 80% of them fail within the first 18 months. Big numbers, Paul. And just briefly to start off with, what are the key reasons for these failures?
Well, I think what you find generally is that they break down into four key areas. One, you've got essentially, dysfunctional leadership or some kind of management team breakdown. Secondly, a weak business model, which just really hasn't been thought through or is fundamentally non-economic. Third, an insufficiently differentiated market or product position, so really just something that's a me too or a copy of something that's been done before. And then the final one is really that the companies frequently raise insufficient capital to fund their initial growth, and so they quite simply run out of steam.
I was very interested in that point, that you look at venture capital funded businesses, and you say the VC failure rate's no better than average, but VC funded companies tend to die slowly. Why is that?
Well, what typically happens with VC-funded companies is that they are classically better funded than the non-VC peer group, and so that they have more capital, and that typically removes one of the problems, which is insufficient capital to fund their initial growth, though not always. VC capital companies can be undercapitalized too. But that means that they have more money, and so therefore the other causes of failure, dysfunctional leadership, weak business model, or insufficiently differentiated market, etc., take longer for the chickens essentially to come home to roost. So they've got more runway. And also there is a tendency on the part of anybody who's investing in these companies to hope and that things will change, that a pivot might generate a change in fortunes. And so you end up with, the walking dead, essentially, or the living dead amongst VC portfolios that can go on for quite some time.
Now, the liquidity bubble has increased the availability of early-stage funding, but you've questioned the quality of that investment and the investors.
Yeah, and I think that, that's flowing through right from public equities right through private equity and into VC as well. I mean, we've got relatively easy, low-cost capital at the moment, or certainly historically low-cost capital. And, whenever you have a surplus of any good in the marketplace, including capital, you can, with poor allocation decisions, and I think that is what we are seeing at times. And we're seeing upbidding of many asset classes, and that in VC in that sense is not really any different.
And in fact, you're suggesting that that the money's been a bit like a lottery ticket to an extent, and some of these early start businesses don't have any respect for the money that they're getting.
Certainly, with anybody who's been through or seen the cycles that have occurred in the Valley, what we are seeing now is not too dissimilar to what I saw in the Valley when I was there in the early 2000s. Relatively high valuations, easy availability of capital does lead to management largesse at times, or capital not being as respected as much as it should. And then you'll obviously move into a cycle where valuations fall, capital injections fall, and that obviously leads people to be a bit leaner and hungrier, which is obviously what Steve Jobs told us that we should be: stay lean, stay hungry, stay foolish.
I'm talking to Paul Adams, the Chairman and Chief Executive of EverEdge IP, and I guess you would say this, but intellectual property due diligence is a bedrock for investing in early-stage companies.
It absolutely is, because it's frequently a proxy for some of those other causes of failure that we talked about before. In other words, if you have poor intellectual property position, it will often show up, for example, in an insufficiently differentiated market or product position, which is one of the leading causes of failure of startups, or it will show up in a weak business model. So oftentimes, by looking at and undertaking correct IP due diligence, you can tell an awful lot about the company and whether or not it's actually likely to succeed. We see no shortage of companies that have been VC or angel backed, where even cursory IP due diligence would have revealed that, you know, the product had been done before, the business model had been tried before and was flawed, that there were large players in the space, that there were superior intellectual property rights already in existence. And when you're risking $2 million, spending a relatively small amount of money on adequate IP due diligence to avoid you making a mistake makes a hell of a lot of sense.
Sure. Now, of course, when things do go belly up, intellectual property assets of these companies are often abandoned or sold for a fraction of their potential value by shareholders. I mean, what can you do about that?
Yeah, it's a very interesting point. If you ask virtually anybody who understands the VC game, they'll tell you that, you know, the most important factor in the success of companies is management, and frequently the cause of these failures trace their way back to management, or, as I said, business model failure or product failure. But IP failure is really it's not very common that is amongst the causes of the company's failure. So in other words, you'll often end up with a situation where the management team has abandoned the company or the product simply hasn't worked out. But the rump asset that's left over is actually high-quality, valuable intellectual property. After all, these companies are typically spending $1 or $2 million. A lot of it goes towards essentially product development, which is essentially IP development. And that rump asset of IP has been oftentimes relatively well curated and managed, etc., and it continues to exist as a valuable asset long after the management team is gone and the VC has turned their attention to something else.
Now, the challenge here, of course, is how you monetize or realise the value of this IP, because it can be expensive and time-consuming.
Yeah, absolutely. I mean, the IP market is still relatively illiquid relative to, say, stocks or bonds, and so that means moving a individual asset is more time-consuming and has a higher transaction cost. But the benefits can clearly there if you do it correctly. A good example of which, we had a company that came to see us roughly a year ago that had been a startup that had tried to commercialise technology and failed. We sold the IP, that was the only asset of that company, within 4 months for a 8-figure sum, which generated a 45-fold return for the investors into that company. Now, that's a sort of a VC-type return off what was essentially a salvage operation.
So what's your bottom line here, Paul, to summarise this chat on how IP is treated in startups?
I think it's that investors are frequently spending a large amount of money or investing a large amount of money. It makes sense to check the quality of the intellectual property. That will often underpin the success or failure of the venture or be a key driver of it. And secondly, when things do go wrong, as they will in any kind of VC portfolio, is to look at whether or not there's an opportunity to actually still realise value out of that investment through the astute sale or transaction of that intellectual property.
Fascinating stuff, and I appreciate your insights. That's Paul Adams, the Chief Executive of Everedge IP.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Duty free. Auckland International Airport's duty-free store shake-up has gone ahead, with one of the operators promising the world's biggest duty-free whisky range. Airport management announced in February it had awarded a 7-year contract from the start of July to LS Travel Retail and Arianta International. The two have taken over from DFS and JR duty-free, with the latter withdrawing from the tender process a week before it closed, saying there was a high level of uncertainty and a very onerous contract. The airport anticipates the new duty-free retailers will add an extra $5 million in earnings before interest, tax, depreciation and amortisation in the 2016 financial year. LS Travel, the Asia-Pacific subsidiary of France-based Lagardère Services, will trade as Alia duty-free and will also open a Queenstown airport branch. Irish company Arienta will trade as The Loop duty-free and employ 225 staff in its Auckland airport and downtown stores. It's a subsidiary of state-owned Dublin Airport Authority, employs more than 3,500 people, and last year had managed turnover which includes sales across all operations, including management contracts and associate companies, of $1.03 billion US. Arienta Chief Executive Jack McGowan, who's in Auckland for the store opening, told NBR Radio that his company will not be any better or worse than the incumbents, but it will do things differently after listening to airport customer feedback. He says, we've heard previous duty-free staff had been too quick or sales-oriented and maybe too keen to shout out to customers that this is a fantastic offer on Bombay or whatever. That's too sales-oriented for Arienta. We train our staff to ask, not assume what customers want, because they're not always looking for the cheapest stuff. Changes also include 10% more overall product range, a 25% larger whisky range, which Mr. McGowan says will be the biggest duty-free range in the world with 216 different types, and double the amount of local products. Arienta will also begin to stock New Zealand products such as Mudhouse wine in some of its 14 other airport stores, including Shannon Airport in Ireland, where the company started the world's first duty-free store in 1947. The Loop store, which opened today, fills the 2,300 square metre space where DFS was, but the company will refit the space over the next 16 months. In People News, a Wellington accountant has been suspended as a chartered accountant after going bankrupt, but continues to work in the industry despite an inability to manage his own finances. Brian John Hutton of Upper Hutt was last month suspended as a chartered accountant by the New Zealand Institute of Chartered Accountants Disciplinary Tribunal. In February, Mr. Hutton was adjudicated bankrupt for reasons unrelated to the accounting profession, and while he was not engaged in accounting work. He self-reported the issue to the Institute, seeking to be convicted and discharged, while the Institute's conduct committee sought suspension. In a judgment today, the tribunal says Mr. Hutton is now working for a chartered accountancy firm, meaning the suspension of his membership for the duration of his bankruptcy was an appropriate penalty. He said in the tribunal's view, a member's bankruptcy indicates their inability to manage their own finances and affairs and reflects on the profession. Mr. Hutton sought name suppression, but the tribunal found the public interest outweighed his own. It said although at the time of the bankruptcy the member was not engaged in accounting work and the bankruptcy was unrelated to his profession, the member is currently working for an accounting firm. Mr. Hutton was ordered to pay costs of $1,000, less than half of what the Institute's conduct committee sought.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to Ask Me Anything, the segment where we put questions from our readers to an invited guest, who this week is Stuart Sheriff, the Chief Executive of 2 Degrees. Welcome, Stuart.
Thank you, Owen. Glad to be here.
We're going to kick off straight away with a question from Jonathan Brewer, who says he loves what 2 Degrees is doing and was a happy customer for several years. However, he moved away after some horrendous data roaming charges. What are you doing to help 2 Degrees catch up with the roaming offerings of Spark and Vodafone?
It's a constant challenge for all operators throughout the world. I think in the long term what you're going to find is that actually international roaming costs will be eliminated completely, and you can see that happening in the EU at the moment. But we constantly out there talking to international operators at various forums trying to get the best deal we can for our customers.
Okay. Why did 2 Degrees, and this is a question from Darren Brownwood, why did 2 Degrees buy Snap to get into the landline broadband market? Why not Call Plus, which is much larger?
Since I arrived in New Zealand a couple of years ago, I'd always been saying that we were going to get into the fixed business. It was necessary for us to compete with the likes of Vodafone and Spark if we needed a broadband product in there. I'm always famous for saying we were either going to build, buy or partner as well. Snap seemed the obvious person to partner with in the early days, and we've been working with them for about 18 months. We got to know each other on an individual basis. We got to know their products. And it just seemed like the perfect match, and it just seemed to be the right size, the right product portfolio, and the right people and right culture. and it's been a great fit for us.
2 Degrees has been surveying its customers about whether they're interested or not in broadband. When will you launch your broadband plans?
Yeah, we have surveyed our customers, but I'm physically out in the field quite a bit myself talking to customers, and it was very apparent to me that was a necessary product for the business environment. Since the acquisition 2 months ago, both teams have been working feverishly to try and get a joint product out there. I'm not going to launch it until I'm satisfied it's the right product for the market. But in true 2 Degrees values, it will be something that adds value to the market. It will be simplistic. It will be transparent, easy to understand. I think that whole segment's got really complicated at the moment. People that ask questions they don't understand. They don't know what they're paying for. They don't understand the acronyms that are used in telcos. So, we'll come out with a really simple product in the near future.
And it's a competitive market, of course. We've got Trustpower, the electricity companies, all pitching for business in that space. Yeah,
we're used to competition, though. I mean, we were the biggest advocates of competition here, so we're not going to shirk that battle.
Fair enough. Now, a question from Amanda Palmer. 2 Degrees is owned by an American company, Trilogy. What other telcos around the world does Trilogy own, and what's the average length of investment?
The short answer to that question, I guess, is Trilogy have owned the company in Bolivia for 16 years, 1999. Just to expand on that a little bit, I'm an ex-Trilogy guy myself. The precursor to Trilogy was a company called Western Wireless International. And they operated in 11 or 12 different countries over the years and then sold that company off to Alltel. It's a great pedigree, huge amount of intellectual property there. There's a number of industry veterans. John Stanton, the chairman and founder, he's actually on the main board of Microsoft as well, so a great pedigree.
Okay. Now, NBR's technology editor Chris Keel asks, do you still talk to Tex Edwards, and would you describe him as an activist shareholder?
Tex is definitely a shareholder, and he's added a hell of a lot of value to 2 Degrees. He was one of the founding members. He added a lot of value in the review of the Telecommunications Act in 2006, which was instrumental in allowing a third operator to come into the market. He's a passive shareholder. He owns a very small amount.
Okay. And another question, slightly related, from a verified NBR reader. What happened to Rhys Darby?
Rhys was, when we approached the market, we took a very, very systematic approach to the whole thing. We realised in the early days we couldn't be all things for everyone. So we recognised that the prepaid segment was probably the first segment we should go after. And Rhys was perfect for that market. He resonated well with the prepaid base, and he served us well for 5 years. And he gradually changed the theme of the ads over that period of time. But we've got to a point in maturity in the company now. I think that our target market certainly is postpaid, both in consumer and in the business. And if you see with our previous campaigns that we had Al Brown and Kate Sylvester and the rest of them, they brought across an entrepreneurial, hey, come and do business with 2 Degrees, it's a smart thing to do. An extension of that advertising is now with new partners such as Juicy, Lewis Road Milks, Whitaker's Chocolate, EcoStore. And so I think it's just a normal transition from one type of brand. Plus, TV is not the media it used to be. It's people are fast forwarding during the ads, they see it once, like it, and it's a very expensive way to advertise as well.
You're listening to Ask Me Anything with our guest this week, Stuart Sheriff, the Chief Executive of 2 Degrees. And I've got a number of questions here from a Chris O'Connell. Firstly, you've done well building a lot more infrastructure than people ever thought you would, but what is the size and value of the infrastructure difference between you and the incumbents, including the capital cost of a roaming network?
Well, we've it's interesting. I go out and about and try and spread the word of 2 Degrees in places like Invercargill, Timaru, Dunedin, all those kind of places, and usually talking to Chamber of Commerce or economic development groups in those kind of places. And there's a huge surprise when I actually tell them we've got 1,000 cell sites out there and we've spent more than $650 million on infrastructure. So we actually provide coverage to 94% of the population of New Zealand at this point in time. Nobody covers 100%. It's you've got a landmass that's larger than the United Kingdom. You've got 4.5 million population, and you've got a lot of big hills out there as well. So no telco could ever cover 100%. The maximum is around about 97, 98, and so for that differential in 4%, we do use a national roaming agreement with Vodafone.
And another follow-up question related from Chris O'Connell. Why is co-location so underutilised in New Zealand? You got regulated co-location but never used it, he claims. The whole industry has to put up with techs going nuts about it. You never used it. Did you get gamed on the pricing?
No, it's a long story. I think, when you're trying to deal with almost 20 different council jurisdictions, each with their own interpretation of the various RMA processes that are out there, there's a limitation on the size of towers you can normally build. Now, you need a tower of a certain height to actually co-locate. You need to get 3 sets of antennas on there. You need a whole bunch of other equipment on there. And if the tower's not sufficient height, you're just never going to manage that. So we're lobbying constantly to try and change the RMA Act to allow that to happen. There is collaboration within the industry. In fact, we're rolling out sites this year, and 25% of the sites that we'll deploy this year will be co-located with either Vodafone or Spark. So it's in all our interests. I mean, this triplication of build of infrastructure. You drive out to the airport, and there's about 4 or 5 occasions when you'll see 3 cell sites. If we can get that down to 1 cell site, there's nobody happier than me, Owen, trust me.
A question from Nigel Jones. Why has 2 Degrees been slower to introduce 4G than Spark or Vodafone?
That was done by design. The vintage of our equipment in the cell sites is much newer than the other operators. So therefore, the transition from 3G to 4G is actually much easier and less expensive. But what we found a year or so ago when we looked internationally, we found that the experience, so most people were investing in 4G and neglecting the investment in 3G. Consequently, the 3G network was becoming very congested. 4G was great, but when you hop back from 4G to 3G, the differential in service was quite noticeable. So we made a conscious decision to beef up the 3G network, and then we deployed the 4G. We've got 4G at 60% of the population of New Zealand now, and deploying that very rapidly.
Olivia Young asks, was the government's 4G spectrum auction fair? Does 2 Degrees have enough spectrum? And if you do, then how can you complain about the terms of the digital dividend auction?
A lot of questions in there, Owen. I think, do we have enough spectrum? That's the first one I'll address. Yes, we do have enough spectrum. I mean, we've got a plethora of spectrum. When you look not just at the 700, we've got 900, we've got 1800, and we've got 2100. I've worked in 21 different countries throughout the world and deployed networks. I don't think I've ever had so much spectrum at my hands at any given point in time. If I was to criticise the event, I think they probably sold it off prematurely. We haven't deployed it yet, so we bought it a year or so ago, and I had to spend money buying that spectrum and haven't been able to deploy it for a number of reasons. I think if they'd held on it for a while, they would have got more money for it.
And part of that question, just to get back to the original heading of it from Olivia Young, was the auction fair?
Yeah, the process was fair, yes. Yes, it was.
Yeah, okay. Olivia Young also asks, when will 2 Degrees introduce a data-only mobile plan?
We actually have data-only plans out there at the moment. There's 4 of them, and they're easily accessed on the website. I would also argue, though, that in this day, anything above $49 on most plans is voice and text is free. So effectively, you're just buying a data plan anyway. Data is the battleground now.
Okay. I have a question of my own as a 2 Degrees, a relatively recent 2 Degrees customer, and that's what you make of the Commerce Commission's call to scrap the use of opt-out pricing. And the reason I ask that is that 2 Degrees has a product called a carryover chat pack, which automatically renews if customers don't opt out.
I have to be completely honest, though, and I'm not familiar with that particular issue, but as soon as I get back to the office, I'll look into it for sure.
The reason I ask is that I, as a reasonably intelligent customer, I'd like to think, had to pay for 3 months of this pack when I only thought I was buying for 1 month. Mm-hmm. And it came to me later that I had to make a decision about opting out. And in general terms, what do you think about opting out as a practice?
I think one of our values is fairness to our customers, and as I said to you, I'm being honest, I'm unfamiliar with the terms of that particular product. As soon as I get back, I will ask the marketing product guys to look into it for you.
Okay. Turning to some personal questions now, Natalie Broadway asks, have you ever eaten a fried pizza and or a fried Mars bar? I'm not too sure why she asked that.
Well, I know. For the benefit of the listeners, that's famous Scottish cuisine, actually. They were the first country to invent a fried Mars bar, which effectively means dipping a Mars bar in batter and throwing it in. You can actually go to the fish and chip shop and buy this if you want. I've never actually eaten that. They do a similar thing with pizza. They throw it in the deep fryer. I've never had one of those as well. I am, however, a big fan of haggis and found a great butcher in New Zealand where I can buy it on a weekly basis.
And another question, apparently you have a fairly gnarly-looking tattoo on your forearm. What's the story behind that?
It's never been described as gnarly before, but anyway, there is a fairly large tattoo on my forearm. I'm proud to say that I was in the Army Reserve for 11 or 12 years, both in Scotland and in Australia. And as a young man, perhaps with a beer or two on board in Germany on exercise, a few of us decided a tattoo would be the right thing to do.
You're listening to Ask Me Anything, and our guest this week is 2 Degrees Chief Executive Stuart Sheriff. What sort of broadband, a verified NBR reader asks, what sort of broadband connection do you have at home?
I'm a proud, used to be Snap 2 Degrees broadband user. I'm probably the first 2 Degrees broadband user in New Zealand. It's on VDSL. I live right in the city, and I'd love to have fibre, but I live in a multi-unit dwelling, and so it's a tad more difficult, but I can't wait till the day I get on the UFB.
And a question from another verified NBR reader, what's in your pocket, iPhone, Android or something else?
It depends on the day of the week, it depends on the week of the month and the month of the year. I'm a bit of a gizmo fanatic, and so I like to try everything. I really like to get inside the customer's shoes, and by doing that I need to experience the experience of the new devices. So typically the latest and greatest that comes out, currently using a Galaxy S6 Edge. I'm up in China in 2 weeks' time, so I'll probably come back with a Chinese one and to give that a bash as well.
You're not like John Key and having to ditch your phone every month for security purposes.
No, I'm not in that category.
Okay. Another question from Chris O'Connell. Was it a mistake being so strong in prepaid in the early days? Won't that make it harder to be in the higher value markets?
No, not at all. I mean, prepaid is a great segment. I mean, if you think about it, there are people who choose for prepaid do it because that's a preferred method of payment. We have a lot of people who pay quite a substantial amounts on a monthly basis, but just prefer to do it prepaid. And you know, as an operator, if someone's going to give you money up front for a product, that's a great place to be. That eliminates a lot of the other problems in the back office. We respect that base though, and we look after it. We give them, we try and treat them as fairly and respectful as possible. There's kind of an equilibrium though in the prepaid market at the moment. We're number 2 in there with 31% market share, and so that's more of a, you know, it's a defensive measure there. All our thrust now is really on the postpaid, either in the consumer base or in the business, the small, medium enterprise. And that's certainly the area of growth, and we're seeing a lot of growth in that area right now.
Obviously, one of the key attractions of 2 Degrees is the carryover element. Just how significant is that for your business?
It's hugely significant. When we were the first operator to introduce that service in New Zealand. In fact, we were the first operator to introduce most new services in New Zealand. But that's, you know, it introduces, first of all, it's fair, and that's one of our values. It's fair to the customer. They've paid for something, they should be able to keep it. It makes the product fairly sticky, so our customers are fairly loyal. It's as though they've got something in the bank there and they want to keep a hold of that. And as long as you're treating them right in all other aspects, hopefully they'll stay with us as a customer.
You're listening to Ask Me Anything with our guest this week, 2 Degrees Chief Executive Stuart Sheriff, Chris O'Connell again. He's been a very busy boy on our website with a number of questions. This one, it looks like you lost $33 million last year. When will you be profitable?
You know, we've been in operation for 6 years now. You know, building a telco network is a very capital-intensive program. We started off with a plan when we first came into the market. We've stuck to that plan every year. The shareholders are happy with our progress, and you know, we're right on target. I think, you know, just evidenced by the support the shareholders have given us in the acquisition of Snap, they're right behind us and they're happy with the plan.
Another verified NBR reader asks, is 2 Degrees on the hunt for further acquisitions?
I've got a bit on my plate right now, get my arms around the Snap acquisition. It's going very well, but you know, I think we're always realistic and we bite off what we think we can chew. So I think we'll be pretty busy at the pump for the next 6 or so months.
And to wrap up this edition of Ask Me Anything, another verified NBR reader asks, what do you think the telecommunications, and this is polishing your crystal ball, Stuart, what do you think the market's going to look like in 5 years' time?
Yeah, that's an interesting question. If you'd asked me 5 years ago, what would it look like now, I probably wouldn't have envisaged the huge increase in data usage. I wouldn't have imagined that people who are using a smartphone, the 5th most popular thing to do on a smartphone is make a phone call. So when you start hearing stories about the Internet of Things, and you know, it depends who you listen to, anywhere from 10 to 50 billion connected devices, it makes you really wonder. You've got the smart homes. I was reading just recently, cows, like real cows in the fields in Germany, have got biometric sensors with SIM cards attached, so they can check various, I don't know if it's blood pressure, temperature, or whatever, what's the right time to milk them. You know, every single car in the world is going to have a SIM card in it. So I think it's just going to be true connectivity at every touch point there is. I think the challenge is to make sure that either gains efficiency in business or quality of life for people. Either way, 2 Degrees is going to be an integral part of that. In 5 years' time, you'll see 2 Degrees will have made its mark in New Zealand to a greater extent than it has done already.
You've been listening to Ask Me Anything, and my thanks to this week's guest, Stuart Sheriff, the Chief Executive of 2 Degrees. Thank you.
Thank you, Owen.
NBR.
Radio.
Free to air online. NBR, the meeting place of intelligent business.
In People News, racing entrepreneur and pet food millionaire Tony Quinn has bought a central Queenstown 3-unit luxury apartment for $7 million. The price is believed to be a record for a central Queenstown home, according to the local Mountain Scene newspaper, which reported the deal. If the price was slightly above market, it was no problem to Mr. Quinn and wife Christina. Last month, they sold their VIP pet foods for $410 million to Sydney-based Quadrant Private Equity. They founded the company in 1994. They'll retain a shareholding, and their older son Kent will retain a management role. The company has 6 manufacturing plants and 600 staff. Meanwhile, Land Records give a rating value of $1.7 million for the 5-level Q1 apartment in Queenstown, with floor area of 229 square metres, located opposite O'Regan's Wharf in Queenstown Bay. The $7 million sale to Quinn Corp was registered in April. He acquired the property from Amanda and Warren Law. Mr. Quinn was also recently in the news for his purchase of Hampton Downs, a motorsport park at Te Kaupata, south of Auckland, for $15.5 million. It complements his family-oriented motorsport venue in central Otago, Highlands Motorsport Park. The local Queenstown newspaper reports he has quit involvement in the Race to the Sky hill climb up the Cardrona Valley to the top of Pisa Range. The track is owned by Southern Hemisphere Proving Grounds. Mr. Quinn wasn't prepared to meet costs, which have risen from $35,000 8 years ago to $90,000. Back to Tiwai Point. The Tiwai Point aluminium smelter's owners are keeping their options open and have made no decision to keep the plant operating, according to Meridian Energy Chief Executive Mark Binns. Mr. Binns says they're playing that card very close to their chests. They've retained the right to be able to walk away or basically cancel the contract from the beginning of 2017. NZ Aluminium Smelter, or NZAS, is nearly 80% owned by Rio Tinto, and Japan's Sumitomo owns the rest. Meridian has granted NZAS an extension of just over a month to August 3 before the owners have to decide on its future. All other terms of the 2013 agreement remaining unchanged. Mr. Binns says, from where I sit, I don't think they've made that decision on whether to keep the smelter open. He says clearly they've been speaking to a number of parties in the marketplace, including ourselves. I don't think they've made a decision that they're staying at all. I think that's still very much in the balance. Mr. Binns says whether the smelter stays open is going to depend on the electricity deal that they can get going forward. He says at the end of the day, this is 40% of our load. It's worthy of quite an intensive management time to establish exactly what our position should be and how far we should be involved in solving the long-term issues that NZAS has with its electricity. NZAS pays less for its electricity than any other power user in New Zealand. NZAS Chief Executive Greta Stevens in a statement said, nevertheless, NZAS is one of the most operationally efficient smelters in the world, but pays one of the highest prices for power. NZAS's electricity costs, combined with high transmission costs and historically depressed aluminium prices, continue to place significant pressure on the smelter. Ms. Stevens says NZAS pays 10 times more for electricity transmission than other smelters internationally, and welcomes the Electricity Authority's recent paper acknowledging that NZAS pays $50 million a year for transmission infrastructure it receives no benefit from. An NZAS spokeswoman says Ms. Stevens won't be available for interviews. For more on this story, go to nbr.co.nz.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Thursday the 2nd of July. I'm Andrew Patterson. This is Media Matters, and with me, Campbell Gibson and Nick Grant. Campbell, let's start with the arrival of Apple Music. What sort of an impact do you think this is going to have on the scene, the media scene?
Well, they themselves are promising it to be revolutionary, and I wouldn't actually expect it to be far from the truth, to be honest, because Apple's got such a monopoly on that music industry that it'll be easy for them, to sort of convert their brand and use it for the service. So its main competitor in this space is Spotify, and Spotify's been around for quite a long time, and they've both got sort of very similar stats. They've both got about 30 million songs. They're both priced at about $13 a month if you choose to pay for Spotify. So the main differentiator here, from what I've seen from commentators, is that Apple's going to rely on its incredibly well-recognised brand, as well as its marketing prowess, and it's a very well-established $800 million user base, and looking at that, you actually only have to see that it'd have to convert about 2.5% of those 800 million users before it's beating Spotify in terms of paid users. So it's it's going to change a lot of things in that industry, I think.
And the issue, I guess, for it will be, will it make money for Apple here, do you think?
I believe so. They've got a lot of things that will sort of place it on top of the other music subscription services out there. Spotify is, it's quite radio-based, but Apple Music actually has its own radio now, and it's also starting up its own social networking service on Apple Music and Connect, so that allows music artists to share photos, videos, songs as well directly to their listener base. So they've got a very strong proposition, I think, and music revenues in terms of selling songs and albums on their own have been sort of declining for a little while now for Apple. So this is a way for them to sort of reinvigorate that industry, and especially pitch it as something that's quite cost effective, because $13 a month, that's the equivalent of an album. So
and clearly it's going to potentially have some impact on the music radio stations as well.
Yeah, well, with that radio station, Beats One is what it's called. I think I've seen a few comments around the marketplace that something like that is going to have sort of an impact on the incumbent music radio industry.
Nick, let's talk about TV ratings out this week. I understand TVNZ announcing that it might be looking to return Our First Home.
Yeah, Our First Home, a reality series in which, what could be more Kiwi than this, families helping their children onto the property ladder. It was, not surprisingly, I guess, in hindsight, a ratings hit for TV1 with an average of 375,000 viewers throughout the series, and the final live auction week attracted more than 500,000 viewers each episode. So based on those figures, they would have been crazy not to renew it. I mean, it's maybe interesting to compare and contrast those ratings with the reality shows that MediaWorks is kind of banking its future on. And, I have expressed a bit of puzzlement about the strategy in the past and suggested that, the reality formats like the ones that they have imported and made local versions of kind of losing their grip on audiences' imaginations worldwide. That doesn't necessarily reflected in the ratings, though. I mean, it's absolutely dependent on the particular property. X Factor earlier this year was something of a disappointment. I think the final of this season drew just around about 320,000, as opposed to 560,000 viewers of 2013 final. I'd be surprised if we saw X Factor in New Zealand coming back to MediaWorks next year, given the kind of costs involved in staging it. However, The Bachelor in New Zealand was a big hit, but that was a show that obviously caught people's imagination, and obviously the various apparently embarrassing stories about various contestants, etc. in the media, I think only helped the show along.
The issue with all of these formats is that they have a good run when they start. Because they're fresh to the market, and then of course the decay factor begins to set in, doesn't it? Yeah, that's right. Well, that's what you tend to think, though. Dancing with the Stars, which was resurrected from from some years ago, seems to be rating its socks off. So they've obviously done well there too. I think a couple of weeks ago they were getting over 400,000. However, the other reality show that TV3 has launched recently, Come Dine With Me, New Zealand, which was a kind of like a quickie that they've shoved into the 7 p.m. slot after the demise of Campbell Live. After the demise of Campbell Live, and after repeats of Road Cops, surprisingly didn't rate particularly well. Unfortunately, Come Dine With Me New Zealand, for the company, isn't performing at all well, and is languishing around about the it's a terrible program. Mark. Yeah, well, it's a shame though, because I don't know. I've only seen bits and pieces of the New Zealand version, but I've watched an episode or two. I had to, for reviewing purposes, a couple of years ago of the British version,
And, as a cheap and cheerful reality show, it does have some merit. And, I think it was well within the scope of the people making the New Zealand version to do a much better job.
Yeah,
it was supposed to be it was supposed to be screening next year.
Yeah.
So they
rushed it.
They were still, I believe they're still advertising for people to appear on it, which isn't.
Yeah, I mean,
great.
The talent selection is so important on shows like that,
Yeah,
particularly when you're in a dining situation to make it work. Now, the other issue with MediaWorks is the departure of some more high-profile individuals.
Yeah, well, I did an online article a couple of weeks ago about the announcement that Herald Gossip columnist Rachel Glusina was leaving NZME to take up a joint venture opportunity with MediaWorks. We canvassed that quite well at the time. But, at the same time, I heard that there were a couple of people being let go from the TV3 newsroom. However, inquiries to MediaWorks, they insisted that actually there were just a couple of positions under review, but have since heard from other sources that definitely John Hale, who's a 25-year veteran of the MediaWorks newsroom and was the lead producer for the 3 News bulletin at 6 p.m, was let go a couple of weeks ago, which is an interesting move. There's a huge amount of institutional knowledge and talent being lost with his departure. And it does suggest to me that that MediaWorks is seriously looking at downsizing their 6 o'clock bulletin to half an hour to bring it in line with what they've done on Sunday.
Yeah, and clearly the Sunday approach is a pilot, presumably, for what's going to be happening in midweek as well.
Yeah, you'd think so. Yeah. And then presumably you'd look at having Story, which is which was announced last week as being the new current affairs show for the 7 p.m. slot. That'll presumably be moved back to 6:30, and they'll have a straight up entertainment show on at 7.
So Newsworthy, despite your prediction, Nick, is probably unlikely to change where it is at the moment.
That's right. I have to put my hand up and admit that I got it totally wrong. I thought Newsworthy, which is the
10:30
the newish 10:30 news bulletin with along with quirky stories, was actually just going to be trialled at 10:30, then shifted to the 7 p.m. slot. I do think, if they'd had more time, I think that may have been what they had planned, but because I think, they had hoped to keep Campbell Live going, I think, until the end of the year. And, that certainly would have given Newsworthy sufficient time to road test the team and product and make it shipshape for 7.
But the decision to go with Duncan Garner and Heather Duplessis-Allen does perhaps reinforce the fact that they do want a harder edge news angle on that slot.
Yeah, well, the bounce back in ratings for Campbell Live when it was announced that it was under threat showed that there is an appetite for it, and the review into the future of Campbell Live did acknowledge that, but they were very clear about it not being fluffy or soft, but something a bit more entertaining, certainly in the latter half of the program.
How do you think it's going to rate, Campbell?
Yeah, to be that, like Nick said, that kickback on the Campbell Live shows showed that there was still quite an appetite for a serious kind of current affairs show in the 7 p.m. slot. And obviously they've indicated that it's going to be a bit more sort of entertaining than Campbell Live, but I would personally expect the ratings to be similar to how Campbell Live tracked, sort of pretty average and okay for the short term, and then over time I think it will slowly decline.
Which then raises this question of why would you get rid of Campbell to put another show on that is just effectively holding the same rating?
That is the golden question.
Well, and the big problem that that Story's going to have, that Campbell Live had, is that 3 News is not delivering an audience of any great numbers to the program. In fact, Campbell Live was often picking up extra viewers that
would come in despite the news.
Yeah, exactly. And a swallow does not a summer make, but there have been a couple of times over the last few weeks in which the TV3 6 o'clock bulletin has been outrated by the 5:30 news on Prime, which ironically enough is also produced by MediaWorks as a
which might be why they're thinking that the half-hour slot is going to be a better format to run with.
Yeah, well, and it's got the advantage of I mean, let's face it. I mean, the 1 hour news bulletin these days on whatever channel that you look at is full of padding, and the intros and outros are incredibly repetitive. Coming up, teasing the content, etc. I mean, the actual news that you have in there, the news that's kind of legitimate and of some import, could easily be boiled down to half an hour.
All right,
and save costs as well.
Thank you both for joining us, Nick Grant and Campbell Gibson, on Media Matters here on NBR Radio.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Let's go back to Kathmandu. A tricky surprise greeted new Kathmandu Chief Executive Xavier Simonet, who must deal with a hostile takeover bid in his first week at the helm of the adventure equipment company. Auckland-based Briscoe Group announced this morning it now had a 19.9% shareholding in Kathmandu, with 4.99% acquired quietly over time, and the remaining 14.91% acquired from institutional shareholders at $180 a share, with about 31 million shares changing hands. It said it would make an imminent offer in cash and shares to Kathmandu shareholders for the remaining 80.1% ownership, although the offer has not been released yet. At $180 a share offer price, which market commentators believe is likely, it would value Kathmandu's equity at $363 million. Large shareholder New Zealand Superannuation Fund, which owns 4.91%, according to a substantial holding notice issued June 29, declined to comment on its investment. But the takeover is a hostile one, launched a day after Mr. Simonet, the former boss of London-based luggage maker Radley, started in his role. Kathmandu says it has had no contact with Briscoe and will not make further comment at this stage. First New Zealand Capital Securities head James Lee told NBR Radio Briscoe has gone hostile in the process, which is pretty unusual. By locking up 20% of the company, it would be unlikely to see a competitive outcome here, given they've got the controlling stake in the outcome. They've launched it a day after the new chief executive has started in Australia, which seems a bit odd. Mr. Lee says the $180 price paid to institutions is significantly above what Kathmandu had been trading at in recent months, but about equal to most broker valuations on the stock, so not a significant premium to fair value. Yesterday's share price was $139, although it soared up nearly 30% to $180 on today's announcement, currently sitting at around $174. Mr. Lee said Rod Duke is seen as one of the most savvy investors in the market in retail, but then he also has a 10% stake in Pumpkin Patch, so the market will be wondering whether this is a good investment or a bad one. The logic that someone would buy Kathmandu is no surprise, as analysts have been flagging that. What we'll be looking for is what the strategic benefit is to Briscoe. Former owners Goldman Sachs, JB Ware and Quadrant Private Equity took the company public in 2009, selling their entire interest, although Goldman disclosed a 12% indirect interest in May. In business news, Auckland startup Code Biotech says a public listing is a possibility. The company, founded by Auckland University of Technology professor Stephen Henry, who also serves as its chief executive, developed a biological paint that's showing promise for use in cancer therapies as well as other applications. Earlier this month, it signed a licensing agreement with UK company Agalimmune that would be worth up to £21 million. The company is 6.03% owned by AUT. The largest private investor is NBR Rich Lister Sir David Levine, who holds a 15.08% stake via a holding company, followed by Professor Henry with a 14.65% stake. It was Code's second deal following a contract with a publicly listed French biopharmaceutical that will allow collaboration to develop new oncology drug delivery products using Code technology. The terms of the deal and the identity of the company are confidential. Last week, Professor Henry was in Boston lining up Code's third major deal. Hot biotechs and medical technology companies have come and gone, with some foundering on the crucial process of US Federal Drug Administration approval, the key step in commercializing a product in the US, and gaining acceptance with regulators around the world who look to the FDA, yet also an extended challenge fraught with bureaucratic, political, technical and financial risks. But on that front, Professor Henry points to the crucial distinction that his company is not developing an end product but licensing technology. Companies that license code technology bear the risk of regulatory approval and bringing code-based products to the market. Code does share in a successful outcome, however. Its deal with Agil'immune includes a royalty on net sales. Code has filed for about 150 patents and secured about half of those so far. Different licensees will put Code's biotechnology to different uses. In Agil'immune's case, it's personalised cancer immunotherapy treatment. Professor Henry says an IPO is an option, but only at the right time.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Thursday the 2nd of July. I'm Andrew Patterson and this is Market Talk. With me I have Duncan Bridgman and also on the line from Craig's Investment Partners, Mark Lister. Welcome to you both. Mark, let's talk firstly about the situation in Greece, of course, the dominant headline for the week. Markets seem to have taken this perhaps a lot more in their stride than one might have expected.
Yeah, that's right. We saw a little bit of a knee-jerk reaction early in the week, but things have subsided, and I guess you've got a couple of reasons for that. For a start, people are just a bit cynical about all this now. We've seen crises in Greece before, and people have got the view that ultimately we will see a deal get done at some point, and even if we don't, the risks around Greece are seen as being a little lower than they were a few years ago, with the European economy in a bit better shape and some of those European officials having a few more tools up their sleeve to deal with any exit and so forth.
Not much of an impact for New Zealand, though.
No, we've been pretty insulated from it now. We're obviously on the other side of the world, so that's helpful. We don't do a lot of trade and so forth with Greece or Europe in the scheme of things. And most of our companies over here are only have very limited links into the region. So we've held up much better than some of those other markets around the world. And I think for us, what's happening in China is a lot more relevant.
Yeah, well, let's talk about that because the China stock market has been particularly volatile. In fact, in the last couple of weeks, it's wiped out all of its gains this year. In fact, it got into bear territory this week.
Yeah, that's right. Sort of down 22% over the last couple of weeks if you look at the Shanghai Composite. I'm not particularly worried about this, to be honest, and the reason is it had such an outstanding run before that. I think it was up something like 150% in the 12 months leading up to that peak earlier this month. So, look, the thing just got so well and truly overheated that a bit of steam coming out of it, even a substantial fall like 22%, still puts it at pretty high levels compared to where it's been over the last few years, and I don't think that's what we've seen in the Chinese stock market is completely reflective of what's happening in the economy. So I'm much more worried and interested in what's happening sort of in terms of the Chinese economic fundamentals rather than the level of speculation from their retail investors in their own market.
Duncan, what's so unique about the Chinese market? Because it's not a market that New Zealand investors can really get access to anyway.
No, that's right, Andrew. I'd sort of echo what Mark's saying. It's interesting to watch what's happening up there, but the effects on what happens here is more to do with the actual Chinese economy and obviously the demand for our goods. But what I have been interested in is just the makeup of how particularly sort of retail investors or so-called mum and dads, Chinese housewives investing, they are borrowing a huge amount of money to make their investments. And in fact, the report said about $350 billion US dollars worth of margin finance, which is what they call our sort of borrowing to invest has gone through since the start of this year, and that's double what it was last year. So, there is a huge risk there if the market does tank. These people are quite exposed.
Yeah, absolutely. And in fact, you've heard about the Chinese farmers now that aren't ploughing the fields anymore; they're playing the stock market. So it really is looking a little bit frothy, perhaps around the top. Chorus came out today with its decision. The Commerce Commission came out with its decision on Chorus. What did you read into that, Mark? Are Chorus going to be reasonably comfortable with this price indication that it's had from the Commerce Commission?
Oh, look, there's a few positives and negatives in there. The total price they can charge for broadband services on average is broadly unchanged from the initial final pricing principle, but it's quite a bit higher than where current prices are at. So, look, the way our take on it was that there's quite a positive there in the longer term, but in the short term it's a bit of a negative. A U-turn on the backdating means that people that were expecting a dividend of around the 20 cent level for 2016 financial year, that's probably a bit too high. So long term, it's not too bad. Short term, probably not the best outcome for them.
And Duncan, did you feel the pricing was pretty well what you were expecting?
Yeah, well, it is what our technology editor Chris Keel had predicted, or there or thereabouts, and. I think short term there was a little bit of, Chorus stock is down 1% this morning, if you can read anything into that. But yeah, I think perhaps it being what it is, the earnings damage is less than initially feared. So, I think, all in all, it's probably, not too bad for Chorus.
Okay, the other big news on the M&A front this week, Briscoe's announcing its takeover for Kathmandu. Was this opportunistic, do you think, Mark?
Oh, look, I think it was. You look at the share price chart of Kathmandu, and it's really fallen off a cliff the last couple of years. Wasn't so long ago that it was close to $4 and sort of got down to 130-ish. So I think there probably is a strong element of Briscoe seeing a business that's lost its way and trading at a very low share price. They obviously still see some good bones there in fundamentals. So I think there is probably a good dose of opportunism there.
And likely to get across the line, do you think?
Oh, yeah, it's a tough one to call. Kathmandu's obviously gone away and is considering it, but there are a few things that might make it difficult to get over the line. Some people will probably view it as quite opportunistic. The big scrip component could be an issue for some Kathmandu shareholders. I'm not sure if all of those, everyone on the Kathmandu register wants to end up with Briscoe shares, so that might put a few people off. Rod Duke still ends up with having a pretty serious interest in the combined business, so that also might be something that some will view as positive, some maybe not. So it'll be an interesting one to watch, but I think it might be tough for them to get over the line.
Yeah, that's what I think as well, Mark. I think while some institutions might have taken the exit route when they were offered $1.80 a share, I think some, particularly the Australian investors in Kathmandu, may struggle to get their heads around this, particularly if it's if they bought in at a higher rate. The other thing is, so Rod Duke and Briscoe are going to have to convince them that they are the right sort of group to take Kathmandu forward and get it out of the slump that it's been in over the past 6 to 10 to 12 months. That said, Kathmandu's got a reasonable board, and it's just got a new chief executive. So, they'll have some numbers coming out. July for. So they've got Easter trading, they've got winter trading. They could bounce back. So. Yeah, there's a lot of balls in the air on this one.
The other issue, of course, too, is that Briscoe's has a strong association with its current lineup, around that core retail offering. And this is getting into clothing. I mean, obviously, Kathmandu does a lot, but there's a lot of clothing elements to it, which is kind of slightly outside of their expertise. Is there a risk here that the whole Briscoe's group begins to become a little bit too diversified, Mark?
Oh, there's always a risk sort of when you go outside your core business and when you take on a company that's got a big exposure to a different country. Australia's been one of the big weak links for Kathmandu, so Briscoes would inherit that market and all the stores over there and would have to sort of find a way to improve the performance over there. But yeah, you're right. I guess the other side of it, though, is that there is a lot of commonality between retail operations and sort of inventory management and promotional activity and all those other things. And I don't think anyone will question the expertise of the Briscoes team, because they've been outstanding compared to just about everybody else in the retail game over here. But like you say, always risks when you sort of take on a big acquisition and move into slightly new territory.
Finally, let's conclude with the global dairy trade auction price out on Thursday morning. Another nasty blow for farmers there, Duncan.
Yeah, well, it's more of the same, isn't it? And this is now starting to become quite serious, not only for farmers but for the New Zealand economy. And as we see the dollar fall again this morning on reflection of that. So, we're taking a large chunk of revenue out of the economy, and it's not just in the rural areas. There'll be other sectors that are affected, flow on from this, and it really is now sort of getting to that crunch time for some of those big dairy farmers that have got a large-scale debt, and I keep reiterating that, but they'll be really hoping for a turnaround shortly.
Is this going to create some dilemmas for the Reserve Bank, do you think, Marn?
Oh, look, my view is that we're certainly in line for another rate cut this month, and probably another 2 after that. I think they'll go very close to reversing all 4 of those hikes they put through last year. So interest rates are going down, and the currency's going down as well. It's pretty clear how things are going to pan out from here in my mind.
Thank you both for joining us. Mark Lister from Craig's Investment Partners and Duncan Bridgman on NBR Radio.
NBR Radio. Free to air online with business news you can use.
In today's NBR print edition, property investment documents obtained under the Official Information Act show tax officials are more concerned about the extent of offshore buyers in the New Zealand market than the government has previously admitted. In litigation news, funder seeks level playing field. Homegrown litigation funder LPF Group tends to stay in the background but is a key driver behind several high-profile cases. That report from Jenny Ruth. To local government, rates rises and the council cost conundrum and fraud tax refunds sought on Ross Ponzi. Plus, New Zealand's rockstar economy is losing its swagger and foreign equity investors are beginning to hunt elsewhere, which may push share prices down. Calder Smiley reports. And controversial research on Crown lease tenure reviews has revealed some parcels of land freeholded and sold by the Crown for $11 million have later been sold for $303 million. Plus our NBR special report, it's all about SMEs. All this and more in today's National Business Review, out now. To Greece and our markets, although it's going to be a volatile week, New Zealand markets have already weathered the Greek storm. Hamilton Hinden Green director Grant Williamson says New Zealand markets have already taken a hit from the Greek financial crisis. He said we saw a sell-off yesterday as it was known that the offshore markets were going to be weaker overnight. Mr. Williamson says he wouldn't expect a big sell-off of financial stocks today, but warns that in Australia there could be continued selling in the banking sector. He said it's going to be a very volatile week. It won't go in a straight line, and we will get some bargain hunters coming into these markets sometime through the week. Mr. Williamson says this week will be all eyes on the euro. He said normally what happens in times like this, where there is a bit of financial turmoil overseas, is the smaller currencies do get sold off. He said with the New Zealand dollar, we have held off quite well against the US, but we've lost a bit of ground against the euro overnight. He says it's hard to predict day to day, but until the uncertainty of Greece is removed from the market, there is going to be a tendency for the downside. In the worst day for US stocks this year, the Dow Jones closed down 350 points, that's 2%. The S&P 500 dropped 1.85% to 2,062. Despite this, Mr. Green says Asian markets were probably expecting the US markets to be down even more than they currently are. Meanwhile, Massey University professor Christoph Schumacher says the chance of Greece defaulting is very real. Greece hasn't got the money, he says, so it needs access to the final $7.2 billion instalment of the EU bailout fund. The EU, however, won't release these funds until Greece agrees to significant reforms. If Greece continues to reject reform measures, the EU is unlikely to bail it out. But while Greece is hogging the headlines, a sell-off in Asian stocks is perhaps more of an issue for New Zealand investors. Global fund manager and PM Capital founder Paul Moore told the Australian Financial Review the bigger concern was China. He said, look at the size of the Greek economy, it's a speck. China's not a speck. Chinese stocks are firmly in a bear market after the Shanghai Composite fell 3.3%, extending losses to 22% from its peak.
NBR Radio with Hotel de Brett, your home away from home, but with better service. NBR Radio.
NBR Radio on Wednesday, the 1st of July. I'm Andrew Patterson. With me, Nathan Smith, for our weekly Foreign Affairs wrap. Nathan, let's start off with Tunisia and France. Obviously, serious developments in the last week or two. Where does this leave the country particularly, and I guess that there's the continued weakness that obviously follows as a result of recent events?
Yeah, look, Tunisia's post-2011 with the Arab Spring is probably, of those countries that were involved in that particular uprising, is probably the best example. Its geography allows it to have quite a homogenous polity all the way through. There's not a lot of obstacles, not a lot of geographical boundaries and things that split a population up. So it's actually very difficult for a group like ISIS or the jihadists to make a dent in that particular polity. But the government is too weak to deal with the jihadists that, by the way, have been attacking almost weekly in some of the larger cities in Tunisia, including Tunis. This isn't the only one that has happened. It has been happening for a long time. And there is a boiling insurgency, especially around the Algerian border, that seems to infiltrate into Tunisia proper. But the country itself and the legislative bodies, they've had a lot of elections since 2011, and they're quite a robust government. They're not likely to be hurt by this, and so you're not likely to see it becoming a security vacuum in which ISIS can move into, as they have in Libya or in Syria. That having been said, they are heavily reliant on tourism. They made a lot of money last year, and there's about 200,000 jobs just dedicated in Tunis to the tourism sector. And a lot of people have been leaving over the past couple of days and unlikely to come back because they will tarnish Tunisia with the brush of North Africa. And unfortunately, that's not fair, but it is what we saw over the weekend, nevertheless. To me, if you step back from that and have a look at what ISIS did, because they did claim the attacks, they also claimed the attacks in France. It's important to have a look as to exactly why they chose to do things like this. To me, it doesn't show strength of the jihadist movement, especially ISIS. It shows their weakness. They were not able to dispatch their own militants from the Syria-Iraq battle space to do what happened in France and Tunisia. They required or relied on grassroots and lone wolves or small franchise cells to do this. And they've been encouraging people to take up arms, an assault rifle or a small hand grenade anywhere in the world. That doesn't show strength to me. In fact, ISIS has not been able to conduct a transnational attack at all yet. So this is all in the larger context of Ramadan as well, which ISIS and other Al-Qaeda groups have said would be an uptick in violence, so expect what was going on. But ultimately, I think the takeaway of this is that Tunisia and France are not going to fall as governments or polities because of these sorts of attacks. They are not existential threats. Yes, they kill people and they're tragic, but there are real ramifications of this. And essentially, these are easy to accomplish attacks, and they're a lesson for everybody, all security services around the world, really.
All right. Let's talk about Iran, because obviously the nuclear deadline, the final agreement, perhaps is only part of the problem. Where does this leave Iran now, particularly vis-a-vis its position in the international community?
They're still wishing to be taken seriously. Of course, that's actually one of the big reasons why they're doing what they're doing with the nuclear program. It's long been suspected that they don't necessarily want a nuclear weapon. That would invite a lot of angst and malice from across the world, potentially even an attack to remove that weapon. All they want is a nuclear program. And the longer that program lasts, the longer the negotiations carry on, the more likely they are to be talking to the P5+1, which is the 5 permanent members of the Security Council plus Germany, and the more they're taken seriously as a nation. So this is important for them on a long-term strategic level. But look, the deadline for this was supposed to be today, but it's been extended through to July 7. And that indicates that there's still a lot of talk to go on here. There's been some worry in the States that maybe Senator Kerry, John Kerry, who ran for president in 2004 for the Democrats, was potentially giving up too much in this, and that whatever deal comes out of this, the Americans have said that they will walk away from. But it appears that, no deal is better than a bad deal used to be what they say, but it really does appear now that any deal is better than no deal, and that's not a good place to be in when you're negotiating. Obama's giving this a lot of cachet. It seems to be the, for want of a better word, the lodestar of his administration. He wants to get this sorted out. And there's a lot of analytical worry that they may be, the Americans and the P5+1 may be giving too much on this. The Americans have changed their stance. They're not as strong as they used to be, certainly not as strong or as forceful as France is in this. And they may be getting themselves into a point where the deal might be useful, but what happens afterwards, that's the real crucial one. Can Iran allow inspections? Does Iran want to enrich uranium? Will it enrich uranium? What's the breakout time for a nuclear weapon? Is it likely to be at some of these reactors or hidden ones that we don't even know about? Is it going to be subject and policing with this document or not? That's the real question. And from information from the Supreme Leader the other day saying that he doesn't really care what's in the document. They're still going to go for the nuclear weapons, or still going to have a nuclear program. There's some rhetoric back home in Iran which makes you suspect that a lot of this could just be rhetoric. And are they really serious? That's the central question.
Because one of the interesting points is the inspections are not actually guaranteed.
No, they're not. And actually, the judicial body passed the legislation in a couple of weeks ago in Iran saying that they are very sceptical of the IAEA and might not actually let them into some of these places. So on one side, the negotiators saying, look, here's what you need to do. This is what we'll try to do. But back at home in Iran, very different languages coming out. And, it seems to me that Iran might have the upper hand in this negotiation process, although it's very hard to see behind these doors.
Finally, let's talk about Greece. Greece is the word at the moment, obviously dominating headlines over the last 72 hours. Greece is in an extremely difficult position, as we know, and it's almost a damned if it does and damned if it doesn't type scenario. How much do you believe that the government really that's left now is almost a puppet government, whichever way that falls, subject to the control of Greece is effectively subject to the control of its creditors? Yeah, the creditors are in control. That is the central point. They went into these negotiations from the Greeks' perspective, expecting to budge the creditors a little bit, the IMF, the ECB, but they've been very strong on that. They want to get their money back. They want to make sure that the system continues to function, which it won't if Greece defaults. And they have this concept that Greece potentially needs to be taught a lesson because you have a lot of other countries, Spain, Italy, Portugal, and Ireland. They're all thinking about the same things. But look, the creditors are in control. The bailout terms are, so far as we have seen, unacceptable to this particular Greek government. But look, they'll have to be acceptable to some sort of Greek government, and that's the underlying point here, is that there is really only one option for the Greeks, and that is to rearrange their financial system, rearrange their government in a way that suits the creditors, in a way that suits the rest of the European Union. A lot of those currently are red lines for the Syriza government, and they won't be willing to trespass them. But that doesn't mean someone coming in later on won't.
And that decision needs to be made one way or the other. And whether or not this referendum on the bailout terms that the Greek Prime Minister set for Sunday goes for a yes or a no vote, his government is still under threat from the internal people. There's a lot of people want to stay in the Eurozone, but a lot of people also don't want the austerity. But something's going to have to give. And there's only one route for this. So if it's not his government, it might be someone else's.
Is the equivalent of the creditors putting it in administrator type situation?
Well, similar to Italy. I think that could be on the cards. Look, it's not going to be an easy move for Greece, and the rest of Europe is watching very closely. In fact, the Podemos party in Spain sent a letter to the Greek Prime Minister saying that they're very happy that he's going for the referendum to bring in the people and get their side of the story. Because, look, ultimately, if Greece can get away with this, why couldn't Spain get away with it?
Portugal or any of the others.
And the House of Cards comes down.
Yep. So clearly that's why we are seeing the Troika remain as resolute as they are, because they know that dissension is going to create serious problems for them down the track as well too.
The EU is bigger than Greece. It's bigger than any one country. And there are forces involved in this that really. The problem is that when they started out with the EU, there was not supposed to be any route to escape. You were in forever. But this is a question no one really expected to ask at this point, and it's just gotten to a point where the forces, the centrifugal forces around the political spectrum are now merging with the economic forces and the social forces, and those are all very different aspects, all interplaying with each other. And it's not just Greece. There's a bunch of other countries, and there's a lot of different reasons for a lot of animosity with the European project at the moment. This is just the tip of the iceberg, and if it's not this, once this is finished, it'll be something else. Look at the Shenzhen Agreement and what borders mean to Europe. Look at what's happening in Russia. Look what's happening with the defence. There's a lot of issues to work out. This seems to me to be the top of mind at the moment, but it is by no means the last.
Thanks for joining us, Nathan Smith, with our weekly Foreign Affairs Scope here on NBR Radio.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Hello, I'm Nick Grant for NBR Radio, and welcome to the Weekend Rumble. Today in the studio we have entrepreneur Lance Wiggs, NBR's Nathan Smith, and on the blower from Christchurch, we've got Chris Hutching. Now, Chris, if we could start with you, it's been a bit of a rearrangement of the deck chairs as far as Christchurch recovery goes this week.
Yes, it has, and sometimes I think that, thank God for the Christchurch recovery for this national government, because I've lost track of how many of these things that I've gone along to, where there's hundreds of people there and the PM gets up with his tie and suit on, and gives an opportunity to say how much they've spent and what they're going to do and how good things are, etc., etc., etc. So they've set up this new thing called Regenerate Christchurch, and it's going to be some kind of transition authority. It's supposedly going to work with City Council, and there's going to be some sort of orderly handover. More of the same sort of stuff that we've heard before. Can't really see what the big deal is about it, but there we go. Probably the bigger news was Fletcher Challenge interested in doing a whole lot of apartments down here. Well, good luck to them, but, Christchurch is not Auckland, and they're talking about apartments sort of between 500 and 900k. Well, that's what the PM says. You can drive and walk, 5 or 10 minutes from that area that they're going to do it, and you'll get all manner of standalone houses for that price. So, anyway, it'll be interesting. It's a long-term thing. It's not even really signed and sealed and delivered. They haven't purchased the property yet. All the sign-offs are yet to happen. So, that's a kind of a work in progress. As regard Sarah, well, fading out, a lot of us just hope it just happens quickly. And I don't think it'll happen too quickly, because this government's got millions of dollars, hundreds of millions of dollars tied up in buying a property here in the central city. Now, look, just to give you an example of the kind of nonsense that we deal with from Sarah, just today, I asked Sarah, PR people, I said, hey, can you send us through some of your market research that you've done about apartment demand in Christchurch, because you will have done some. And I get the response back about an hour ago saying, I've just talked to the guys and they say it's commercially sensitive. You'd have to put in an OIA, an Official Information Act request to get that information about market research on apartment demand in Christchurch? Well, really, I mean, do I laugh, cry, temahera it? Frankly, I'm not going to bother, because there are lots of other sources where I can get this sort of information. But yeah, that's the kind of nonsense we're dealing with. Now, moving on to other South Island news at the moment, the Yealands takeover, or the takeover of Yealands by Marlborough Lions. That's been a story that's excited an awful lot of comment and interest, and the main comment being, what on earth has an electricity lines company got to do with a wine company? Well, there are some sort of synergies. You'll find that these directors of the companies, both companies, Yealands and Marlborough Lions, have been involved in each other's companies. Some of them are wine companies unrelated to Yealands. So I guess you get this in a small community, you know, where guys are on each other's boards, but it all seems a little bit cosy.
It might sound cosy, but if you think about what all of the other electricity or the Lions companies did in the other regions, the regional council, whomever sold the company, and they formed a trust, and there's quite a few of these scattered around the country.
That's right.
And those trusts are now investment trusts, and those investment trusts are making investments. But these guys, they still own their Lions company. It's still making money, and so that now the Lions company's turned into an investment trust. I actually think that's a really good thing, because a Lions company is a license to print money, right?
Yes and no. There are the new rules come in from the Commerce Commission, may recall, about the returns that they're allowed to get, and I think
7.1.
The CEO told me that it was something like 7% per annum. I think this cap's been put on it. But look, the interesting factor here is that 2 directors of Yealands, independent directors, resigned from the board of Marlborough Lions.
Do they have links to Yealands? Do you know?
I don't know that they did. That's not why they left. I can assure you that the reason they left was over this deal. So we got 2 directors from Marlborough Lions jumping ship 2 weeks before this is announced. And as I say, I can't tell you why or how I know this, but I can assure you that it was unhappiness over this deal that led to them jumping ship. So that in itself speaks volumes, I think.
Do you know what the unhappiness was about specifically?
It revolves around, generally, without me giving away too much, concerns about the enterprise cost of the investment, and I think also the nature of the Lions company spreading its purview to that area. Because although these Lions companies do make investments and have done, like Vector in Auckland has got a gas offshoot, and Orion in Christchurch has done this before too, generally they tend to kind of stick within the energy sector. This is probably the first time I've observed such a unusual shareholding.
Have you spoken?
It won't work.
Have you spoken to the owners of this outfit?
The trust, as yet I have not, but they put in an expression of support in the official statement that came out. So I don't think there's going to be an issue there.
So for me, that's clearly you don't do this and just spring a surprise on your owners. Clearly, the trust and most of the board were aligned. Clearly, one could argue that the trust was over the valuation as well. And these directors probably felt that they're inappropriate directors for a company that's a more diverse company, and it's their prerogative to resign. I always think you should if you feel it's the wrong business for you to be in. The only thing that would really worry me is if they resign for ethical reasons, and it doesn't feel like there's a sniff of that here, or do you think differently?
Well, it's very hard to tell at this distance, Lance, but I'm touched at your faith in corporate life, but I tend to think that these guys wouldn't be ditching their fees without a pretty jolly good reason. And like one of these directors that we're talking about, Anthony Beverley, he's on the NZX listed PFI. He used to be a director at AMP Capital Partners. He's the kind of guy that's very well aware of ethical and legal liability issues. These guys are obviously uncomfortable about this. So again, to me that just speaks volumes really in itself.
Various misgivings aside, I mean, one thing I do like about this deal, with my superficial understanding of it, is that it does keep this wine company in New Zealand. I'm sure Peter Yalens could have got a much better offer from offshore. And I interviewed the guy a few years ago for another publication, and I have to say I quite like the cut of the guy's jib. I mean, they were very much focused on being a sustainable company, and best practice in that respect. And
well, that's a bit of an interesting joke in itself, isn't it? Because in fact, if Peter Yalens had his way, he wouldn't be relying on the electricity grid, would he? But there we go.
Well, that's true.
No, I think that Yalens, is a great character. He's had this company on a huge growth path since 2008. It's now 2015, and it's enlarged by a couple of times. But that in itself, you got to ask yourself, how did that come about? How was that funded? It occurred through the GFC. He'll be watching the cut of his cloth, I think, in terms of debt. We don't know the details of that.
Is he stepping out, or is he's
No, he's going to remain, and he's remaining as a 15% shareholder, plus he's going to be running the ship, I think, for a while. There'll probably be a transition phase.
How old is he? Is he retiring age, or...?
Now, I don't think these guys retire.
No.
I think he's well past the official gold card age, but he'll always have things going, this guy.
Yeah.
And it's great outcome for him. I mean, he'll be, rubbing his hands all the way to the bank, and good luck to him.
Well, moving on from what's happening in the South Island, or the top of the South Island, to the South China Sea and beyond, Nathan Smith is going to talk us through what the implications are of the China economic slowdown for both New Zealand and the global economy. Obviously, there's been a lot of chatter over the last week or so about Greece's issues, but China is really where people should be keeping their eye on, right?
Well, especially down here. It's a bit far away to talk about Greece as being an impact on the New Zealand economy, although it does. There's been a bit of data come out. Again, it's just the final quarter results from quarter two, manufacturing data from China. Just show the same. It's just another data point showing that the slowdown is real and seems to be more exacerbated than most people, I guess, pay attention to. It's hard to trust some of the data that comes out of China. We all know that. But after a while, you start to pick up some patterns. And they're looking for, majority of the time, 7% growth, and they're about on that. If it drops below that, there's a bunch of doomsayers that say that China will collapse as we know it and will enter into a new stage. That's unknown. This is new territory for China. The last time they were at 7, they were on their way up, but they're on their way to a stagnant place, or at least below. We haven't really seen China like this for a long time, and it reflects really the rest of the world's economy. The reason this is happening is not necessarily because they can't manufacture enough. It's because we aren't consuming enough. And this happened really after 2008, when the bubble burst, essentially, and Europe, which is still struggling, and the United States, which is muddling along but still growing, just simply doesn't want as much junk or stuff, depending on which word you want to use. And also, when this sort of happens, the amount of effort that China put into that particular part of its economy means that its inflation rises quite high, and even a small inflation rate can affect China beyond the face of it, and it's not going to end very soon either, because there's a lot of other countries in the Southeast Asia and East Asia region who are picking up the slack, so to speak. TPP is just going to exacerbate that trend, making it easier for Western companies to put their industries in those countries, and a lot cheaper for them to do so, and they are. So it's just more data points pointing to a new reality, I guess, for China.
I guess it's a reminder, as if we needed it, though apparently some people do, that we shouldn't be looking to China as our as the place where we put all our eggs, or rather milk powder. And
no, not really. And our trade team's probably the best we've had in a long time, and they're opening up a lot more portals for us to diversify. But you put it into context. I mean, the United States barely scraped 1% growth in the last quarter. And that was a worry. I mean, obviously, if the United States sort of stumbles, the whole world really stumbles. But it's not even scratching 1%. China's barely scratching 7%. Most countries, most economies would give their left arm, probably both arms, for that sort of rate. So it's still high.
Let's sort of step back a little. If you think about USA, I mean, they're a vast market. I mean, 1% growth, who cares? It's so big, it doesn't matter from any companies that from here, you can go in there and grow forever. China, slowing the growth rate down a little. Europe, some serious worries about what could happen over there. But then you look at Fonterra, and they're internally, there's probably a technical word for it, but it starts with F. But they're stuffed, right? And they're going through some redundancies right now, and so on. And the milk thing is a huge driver in our economy. So put all that together, and how do you feel about the next 6 to 18 months?
Big question. I wouldn't want to comment on a lot of what Fonterra does, and that's not really what I look at. However, I would suggest that the numbers aren't of how much Fonterra and milk and dairy, how much they make up of our actual GDP. Is probably lower than most people realise. There's actually a lot more to New Zealand's economy than just dairy. Whether they fluctuate does affect our dollar. That's accurate, and we do struggle with that.
Don't forget that. So I'm involved with one company that has a major customer who is a supplier to farmers who are in dairy. So that's 2 or 3 or 4 layers away from Fonterra. But those guys are seeing a bit of a downturn because the farmers don't have checkbooks right now. So it does spread throughout our economy quite a lot.
Yeah, it does. And it also, because they're so large, the other economies around this region and beyond, it's not just the Asian region, well, when they stumble, that makes Fonterra think twice as well. I'm not sure what the next six months lead to. I do know that if you're looking for trends, you should start to notice a pattern in China, especially its manufacturing output and the rest of what it's trying to do with its economy. What you should do as a long-term decision maker for a company like Fonterra is, I think, continue to do what they're doing, diversifying. And these things have offset sort of benefits. You start now, and eventually that comes through. To expect that a new farm, perhaps in South America, where they're doing what they're doing in China, where they're making milk on site almost. That stuff takes time to come to fruition.
Mm-hmm.
And they're a long-term company, and as the Australians like to call it, white gold is going to be around for a long time. And the protein isn't just needed in China, it's needed in India, and it's needed in Indonesia, it's needed in most Southeast Asian countries, especially as an economy grows. The demand for protein rises exponentially, almost. And I use exponentially very colourfully.
And I guess you've got India, but they don't really do milk as much, right?
No, and they do like it and they do want it, and they're looking for a lot more of our technology, which we've been very useful in developing for dairy. So I would suggest that the long term is unknown, but I would put my thumbs up for it.
Interesting. So you'd buy a farm?
Yeah, of course I would. Yeah, I'd love to go out there and just shoot some ducks or maybe some... Oh, you mean a real farm? Yeah, right.
Gentleman farm.
Speaking like a true Aucklander. Speaking of which, going to an Auckland topic, well, Lance, you've got a couple of things to celebrate. You'd like to celebrate this week, I think. One's Skypath.
Yeah,
which I think you'll need to kind of spell out in some detail for people who don't live in Auckland, and also for me actually, because it's not something that's really impinged on my awareness. But also your highly successful fundraise.
Sure, it's been a fantastic day actually. So and week. So Skypath is the clip-on path that attaches to the right-hand side of the bridge going north, and the reason. And you can walk and cycle over this thing, and it's still in the design phase. And today the new news was it passed the consent process, and it was quite a interesting consent process. He had over 10,000 submissions for it, and a few hundred or less than that against it, and some very, very vocal residents on the north side who were worried about these crazy cyclists destroying the neighbourhood and taking away their car parks and things. So it was quite a fraught process, but very professionally run, I think, by people on who were building the thing, and they got it through. So what is it? The reason you can do this, by the way, is when they strengthened the bridge about 10 years ago, I think, they calculated it based on how much they need to strengthen it based on the traffic going each way. And then some smart person figured out that the trucks coming back over the bridge south were generally empty. And so therefore the weightometers and things that they're measuring the load on that structure were not showing as much traffic as they anticipated. So there's this extra capacity that was allowed. And so someone figured this out and said, well, if you guys can design something that would fit into that weight, and good luck with that, you can put on some sort of bridge for cyclists and pedestrians. And there's a guy, Bevan Woodward, who's basically the driving force behind this. And there's a trust formed called Skypath Trust that drove this for 8-10 years now. And they got some smart people with them, and they designed this basically carbon fiber, fiberglass, Kevlar, whatever the hell it is, thing that clips underneath the bridge all the way across. And it's pretty as well. And off they go. And engineering-wise, it works. They tested it through various engineering firms, and there's been a lot of people helping out along the way. And I've done a little bit myself. And today is an important milestone for them in that they got that approval. They still have to get, and it's an interesting deal because it's a PIP deal. It's a public-private partnership deal with a fund attached to Infratel. And so some very smart players involved. And so the next stage is to get it through council hearings. And I'm not sure what that involves, but it's not over. It's not done yet. And obviously there's several parties involved to get this thing over the line before it starts getting built and then used.
Are you going to have to pay for it, Lance?
You are going to have to pay for it. It depends on when you go over and who you are, and I'm guessing the venture that runs the thing will be smart. I hope they'll be smart about how they price. I can't guess as to how they would do that, but I imagine if you're a tourist from Christchurch and you're here just for the day, we could charge you $1,000. And if you're a commuter running across it every day, it'll be something more like 10 cents. And I'm being a little bit facetious, but I think that's the way that I would run the pricing, is to price accordingly. And I think it'll be a wonderful experience because the idea is you link it up so that you can cycle all the way from St Heliers to Devonport.
Magnificent. Look, when I was in Auckland a few weeks ago, there was I was shown my brother lives in Mount Albert, and there's one that stretches all the way from Mount Albert into town, isn't there? I don't know what you call it. And I mean, what an amazing thing that is, really. And I just hope that Aucklanders, get out of their cars and start to use it as a matter of habit, because that's what biking's all about. The more you do it, you look outside there some days and you think, oh, she's a bit wet, don't want to do that. But you get in your car and it's so frustrating. Whereas when you're on that bike, you might have been moving fast, but boy, it's refreshing, and you're out there in the fresh air.
I've found that too with a motorcycle, cycle, drive cars, walk, take public transport. I do a bit of everything, and I really changed my mode based on the length of the thing and so on. I found on the motorbike, the days that you really don't want to get on the bike because it's so pouring, they're the days that you gain most advantage by being on a motorbike because there's so much other traffic on the road and you can lane split or whatever. The bicycle I cycled here today, it was raining on the way here. I didn't even think about it. I just had my long coat on and my business coat and just cycled here, and it's really easy. So
you just get used to it, don't you?
You just get used to it.
Cake.
Yeah, really. And so around town, my range of my bicycle is from downtown up to Newmarket, which is up to Parnell, up to Ponsonby. That's my range on the bicycle, and I love it. It's an electric bike, by the way, so I can go there and turn up without sweating.
Or lazy.
Yeah, and so today I visited one of the companies that Punakaki Fund invested in. This is a good segue, right? Which is Boardingware, and then they were over in bottom of Parnell there. And then I went and saw the Snowball guys and gave them some champagne because they ran a fantastic campaign for us to raise $2 million on their platform, which is the maximum. And we actually we had one investor who jumped in the private offer as well, and so he moved his Snowball one into the private one. And and we managed to hit the 2 million limit twice, and we had a lot more demand than that, it seems.
Wow. What was the total cost again, Vince?
Our total cost
of building the thing?
Of building the snowball offer?
Yeah.
So we charged consumers, we charged the people 3% our brokerage fee.
Oh, no, sorry. I mean, how much is it going to cost to build the thing?
To build what? No, this is... Oh, sorry, Skypath. You're back on Skypath. So I just segued out of that so beautifully, and then now we're back.
Well, that's because it was too beautiful. It was seamless.
Things in Christchurch are a bit slower, aren't they? So it's about... it's over 30 million. No one really knows what the exact number is going to be. I guess, the people that do need to know do know. But
actually, just before you segue back to something else, do you think it'll take off some of the reasons for making a second bridge if they can make foot traffic like this?
I would hate to conjecture on that in a way, but
go on.
I think there's two ways to look at it. One is, yes, of course it will, because people will get out of their cars and into vehicles, unless it rains, in which case it'll be interesting. So you could arguably see that happening. But the second thing is, you could say that, well, if they do a second crossing, then you now don't have to build a cycle lane and a walking lane because you've actually incorporated it. So I think NZTA would probably support it on that basis, given that there are a whole bunch of engineers in there that like big projects. And, hey, I'd love to do a tunnel. That'd be so much fun because I love big projects. And that's kind of the way I'm guessing many of them think. And if you look at the latest budget, the numbers that the government has spouted this week about how much money they're spending, it's all on big infrastructure. It's not on the small things that actually make a bigger difference. Because that's the way they think, and so I think that's probably how NZTA would see it. Mm-hmm. I'm fine with that as long as you have a train in that tunnel. I'm fine.
I mean, how much do you see Skypath as being like a microcosm of the kind of challenges that Auckland has in terms of getting its act together to get a coherent transport plan? Because and
it will link everything up, and that's the you'll link the North Shore and their cycle lanes with over here. You'll actually, I cycled to see the businesses we've invested in here. Oh, maybe I can invest in something in Takapuna now. Maybe I'd consider living in Takapuna. Yeah. Probably not. But that's, I think it's a huge part of that integrated transportation system. And yet they had to go to the private sector to get the money.
Yeah.
Right? And thankfully, the private sector was smart enough, and there's some very smart players there. And the council's smart enough, and everyone's collectively smart enough to actually make this work. So it's a kind of a no-brainer for the council.
Well, you'd think so, wouldn't you? But I mean, beyond the technical things of it actually being achievable and the funding, but there's still, as I understand it, quite a lot of voracious objections to the idea of it, and I can't quite understand.
When you say a lot, I think there's maybe 20 or 15 or actually 3. And they've had their day in court, as it were. That they've I think I've been very impressed with this process. They've had a very full and frank exchange of views with the EPA, whatever it is, the approval process just now, and they had a lot of airtime, they had a lot of submissions, and watching some of the things go by, it felt like the people reviewing this were actually very much on side of the people who were objecting, and I don't think anyone was that confident this was going to go through. So it was very pleasing to see a very fair and balanced result that went the right way. So they've had their day. They'll still talk. There are people on the council. Dick Quacks was one today who are still going to be against it, but Dick Quacks is against everything. So there you have it.
Just on a kind of related note, rates are obviously a bit of a topic at the moment, and I know.
It was bullshit because the survey said that everybody wants to pay more money and get better public transport. And then the Herald's article last week was abhorrent. They said 10,000s are going to be paying over $1,000. Actually, it was 9,000, and actually most people are going to go down. I think, or a big chunk of people are going to go down in their rates. Yeah. Anyway, sorry, back to you.
Oh, well, yeah, I think, I was looking at this subject in the past week, and got an article that I wrote with Sally Lindsay in the Current Issue. Also, there's a column by Rodney Hyde on the subject of rates, and he takes a very interesting angle. He says, people are up in arms, etc., but the reason they are is that rates are transparent. And if central government had the same kind of transparency around their taxes, then there would be pitchforks marching on Beehive instead of people up in arms about their local councils.
I don't think Rodney Hyde's met a tax he didn't want to put a pitchfork into, to be fair.
Well, sure. But there's I guess an acknowledgement there that actually I mean, he says that transparency is good because it keeps councils on their toes, etc. But if you really want to look at a problem, look at central government, and I think you can kind of argue that one of the reasons for the Auckland's rate rise, for instance, is a government that is, as you were saying earlier, is intent on putting in big ticket projects which aren't necessarily going to solve the problems which we're presented.
True.
Sadly, does it make any difference though? I mean, you're right about the transparency. You can go through the LTCCP and you can see all the projects there, and I do this, and I look at them and I scratch my head with wonder sometimes, but none of these people that are putting them forward, especially the staff and the work programs, nor the community board members, are ever going to tell their people in their wards that, no, forget it, you can't have it. I mean, they just are not prepared to do so. They haven't got the guts and the courage to do it.
You're talking about if I look on the ward level in Auckland, and I sort of look on a couple of wards because we traverse through them, I think they've been very, very good at telling the people inside the ward what the money's being spent on and getting their feedback.
Yes, they're good at telling them what it's being spent on, but they're not good at telling them that, maybe this is unaffordable and you're adding to the whole problem.
No. There's definitely constraints. I mean, there's definitely, they say we can do this, we can do that, but they're not saying we're spending a whole bunch of cash, and they're asking for opinions, and they're very good at soliciting feedback. I've been quite surprised actually how good it is, and it feels like they've embraced the power of the internet as well, and the listening to people, and a part of that, you come to Auckland one day, and it's actually quite a nice city now. I used to hate this place, It's pretty good.
That's great.
Yeah,
I can tell you, being in a place that hasn't got much of a central city yet, but it's happening. When I was there a few weeks ago, it's fantastic. You go out at 10 o'clock there from a hotel where I was staying at Debrett's, and there's people doing stuff. It's great.
Yep. And around Debrett's, probably what they're doing wasn't legal, but it wouldn't have been in the past. It is now. I think in Christchurch, coming back to your point earlier, the stuff that's going really well in Christchurch is the private sector, and I hope this regeneration thing acknowledges that that's where the success is coming from and doubles down on it.
Well, that's right. And I've had a couple of discussions with other media here today, and we're all saying the same thing. Look, people mustn't get the wrong idea. It's not as though nothing's happening here. Tons is happening. And you walk down Cashel Street and there's these buildings going up all over the place. But this is the bad joke, is that the Sarah bits, the bits that are controlled by the Crown, haven't gone ahead. Now, I'm not saying that there should never have been an organisation like that. They've cleaned the place up. They've made people pull down buildings. They've done all that. But they cannot direct a rebuild.
I sometimes think that the national government does these things to prove their point that government's not anywhere near as good at doing things as the private sector.
Well,
cynic.
One of the things that you guys wrote was that this new organisation is going to be part of the responsibility for Christchurch goes into IMBI, and Stephen Joyce is in charge of that, and he's the Minister of Getting Things Done. And you know what? Eventually, he's just going to be running the entire country, because he does seem to have this incredible ability to run a wide variety of organisations extremely well. Stuff does get done across his portfolio.
Really?
Really.
Well, let's leave it on that thought.
No, he does. No, you may not like what he does, right? You may not like that he's building so many roads or whatever, but roads get built. Simple as that. So.
Some bridges, however, not so much, as reported. Well,
right. Let me use that bridge to segue back to the fund. Wasn't that good?
You're on fire,
not so smooth, but so we had a great time with Snowball, got $2 million. We had an option round in the background, raised another $1.8 odd million, but over that, 100% of the options were exercised, which is kind of nuts. And we also raised $900,000 or so in our private offer so far, still time. And so overall, maybe $4.7 million. With the Snowball one, it's interesting. They still have to go through and validate all the eligibilities and the anti-money laundering stuff for everybody. So some of that may fall out. and that's normal apparently. But overall, we're extraordinarily happy. And what I think is more important here than what we did is, I think this is further evidence that this crowdfunding thing works, and that there are some deals that have gone through that aren't so good, and there are some deals gone through that are pretty good. Our one, I think, is absolutely amazing, of course, because I'm completely biased. But I do think that they've discovered something here, and the FMA has been very, very professional and helpful in this process as well. And they're watching it, and they're I think New Zealand is really doing something right here, and you can see a future where the limit goes up, where there's trading of the shares and in some sort of aftermarket, and this is essentially disruptive of the NZX. That's where it's going.
Look, I'm afraid we really have to wrap things up now, but Lance, in 30 seconds or less, are you able to talk about what made this go off so successfully? I mean, there are a couple of key things that you guys did which...
Sure. So one of this, we were already invested in 10 companies, and they were great companies, and many people knew those companies. Second one is we made an offer before we went live privately to the people that gave us money in the first IPO, or the public offer we did 2 years ago, and then we made another offer to the people that had signed up for early warning, and so we already had momentum when we went public. And then I think it was just a very well run, very nicely run campaign by Snowball and the people that supported us. It was all very positive, and NBR ads, I think, were the final factor. Though we had ads on the NBR Online, and that, I think, pushed us over the edge.
Good to hear. Well, and on that note, thank you, Lance Wiggs, Nathan Smith, and Chris Hutching. Hope you all have a great weekend.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.